I invite you to provide an opening statement if you wish.
Thank you very much, Chair, and thank you to the members of the committee for once again holding this hearing. Last week, as you would know, the Reserve Bank increased interest rates by a further 25 basis points. This brings the cumulative increase since May last year to 3.25 percentage points, with the cash rate target currently standing at 3.35%. I'd like to begin today by discussing why this increase in interest rates has been necessary, and also to discuss the outlook for the next couple of years. At its core, the rise in interest rates has been required to make sure that the current period of high inflation in Australia is only temporary. That's the job for the Reserve Bank of Australia as the country's central bank. In the December quarter, the inflation rate reached 7.8%. That's the highest since 1990, and it's too high, way too high. The inflation pressures were broadly based, with the prices of almost 3/4 of the items in the CPI basket increasing by more than 4% last year. In underlying terms, the inflation rate reached 6.9% in the December quarter. Again, this is the highest rate in decades. It's too high, and it's higher than we were expecting just a few months ago. High inflation is damaging and it's corrosive. It hurts people. It puts serious pressure on household budgets, and it erodes the value of people's savings. And it increases inequality, and it hurts most those on low incomes. High inflation also damages longer-term economic performance, making the environment for businesses and households more uncertain, and makes it harder for firms to invest. And if inflation does become ingrained in people's expectations, bringing it back down is very costly. History teaches us that once inflation becomes ingrained, the end result is even higher interest rates and greater unemployment to bring inflation back down. So it would be dangerous indeed to not contain and to reverse this period of high inflation. This episode of high inflation has its origins mainly in developments on the supply side, but over time, demand-side factors have become more prominent. It emerged in the wake of the COVID supply chain disruptions and Russia's invasion of Ukraine, but strong domestic demand due to the bounce back from COVID and the large policy stimulus from both fiscal and monetary policy during the pandemic has also played a role. Most advanced economies are in a similar position to Australia and have responded with higher interest rates. In some cases, they've responded by increasing interest rates to a level substantially higher than the level we have here in Australia. In broad terms, the RBA and many other central banks are managing two risks. One is the risk of not doing enough, which would result in high inflation persisting, and as I said earlier, it would then be costly to bring it down later on. So one is the risk of not doing enough. The other is the risk that we move too fast or too far, and the economy slows by more than is necessary to bring inflation down in a timely way. The path here is a narrow one. It's still possible for us here in Australia to navigate this narrow path, especially if inflation and wage expectations remain contained and issues on the supply side continue to be resolved. But it's also possible that we get knocked off this narrow path. Not surprisingly, given the various uncertainties, there are a range of views in the community about where the main danger lies. Some are more concerned about the prospect of a sharp rise in unemployment in the near term, while others are more concerned about the prospects of inflation staying too high, which would in time entail higher interest rates and a sharper rise in unemployment. As the central bank, we have a critical mandate to preserve medium-term price stability, and we're committed to that objective. If we don't get on top of inflation and bring it down in a timely way, the end result will be even higher interest rates and more unemployment in the future. The instrument we have to achieve this is interest rates, which I acknowledge can be a very blunt instrument. We're very conscious that the impact is being felt quite unevenly across the community. Around 1/3 of households have a home loan, and many are finding managing the higher interest rates very difficult at the moment. But the mortgage market is only one channel through which monetary policy works. Changes in interest rates also affect asset prices, including housing prices and the exchange rate, and they also affect the incentive for all households to save and to spend. Changes in interest rates also affect expectations of the future, which can affect spending plans and price and wage setting behaviour. These various transmission mechanisms take time to work, and their effects are not fully are felt unevenly across the community. As difficult as this unevenness is, our job as Australia's central bank is to deliver low inflation for all Australians, and to do so in a way that best contributes to the collective economic welfare of the Australian people. That's our job, and that's what we're attempting to do. I'd now like to turn to the bank's updated central forecasts, which were released last week in the quarterly statement of monetary policy. These central forecasts have Australia staying on that narrow path that I just spoke about. They have inflation returning to target over the next couple of years. They have the economy continuing to grow, albeit at a fairly slow pace. And while they have unemployment rising, it's expected to remain below the pre-pandemic low. So a central forecast is that we stay on that narrow path, that we bring inflation back down, the economy continues to grow, and the unemployment rate remains below where it was before the pandemic. But there are risks around that, and I'll talk about those in a few moments. Our assessment is that inflation is likely to have peaked at the end of last year and will now start declining. The central forecast is for CPI inflation to decline to 4.75% this year and to around 3% by mid-2025. We have not yet seen evidence of a moderation in goods price inflation in Australia, but we've seen evidence of that elsewhere around the world, and we expect the same to take place here over the months ahead. Supply chain problems are being resolved, shipping costs are normalising, and oil prices are off their peak. These lower prices and lower rates of inflation in global markets should flow through into prices in Australia. While this will help in the return of inflation to target, it's unlikely to be enough without also observing some ongoing moderation of demand. In terms of economic growth, our central forecast is for GDP growth to slow to around 1.5% this year and next. The bounce back in spending following the pandemic has largely run its course, but more broadly, the combination of higher interest rates, the cost of living pressures on households, and the decline in housing prices is expected to weigh on household spending this year. There's also a contraction in residential construction after the boom of the pandemic years. In contrast, the outlook for business investment remains reasonably positive, with many firms reporting that they're operating at a quite high level of capacity at the moment and they're continuing to invest. The labour market remains tight, with the unemployment rate near a 50-year low. The share of working-age Australians with a job has never been higher. Youth unemployment has declined, and the underemployment rate is the lowest it's been in decades. These are really good outcomes for the country. Job vacancies also remain near a record high, although there are some firms reporting to us that it has become less difficult to hire workers over recent months. The central forecast is that the unemployment rate gradually increases due to the slower growth in the economy to reach 4.5% by mid-25. This rate of unemployment is below that prevailing in the years prior to the pandemic, and if we can achieve something like this, the country will have managed a sustained reduction in unemployment, and this is something that we should all welcome. I'd now like to highlight a few of the many sources of uncertainty around these central forecasts. The first is the global economy, which is in a challenging position. The synchronised tightening of monetary policy, high energy prices and cost of living pressures mean that global growth is expected to be quite weak this year and next. It does remain to be seen what effect the cumulative and substantial tightening of monetary policy has and will have on overall spending. There are risks here that central banks have done too much, but there are also risks that we have not yet done enough. There's also the possibility of new shocks, including from geopolitical climate events. More positively, the change in China's COVID policy and a shift to more growth-oriented policies by the Chinese authorities are positive developments for the near term. Lower energy prices in Europe have also reduced some of the downside risks to the global economy, but as you know, there are still substantial risks there in Europe. A second source of uncertainty is the outlook for household spending in Australia. It's really positive that people are finding jobs and they're having more success in getting the hours they want. These extra hours and jobs are supporting growth in nominal household incomes. Furthermore, since the onset of the pandemic, households have saved an additional $300 billion over and above what they would normally do. $300 billion. That's a very substantial stock of extra savings, and it's equivalent to around 20% of annual household disposable income. Moreover, the national accounts suggest that at least until the September quarter, households were still saving at a slightly higher rate than they were before the pandemic. So they're positives for household finances. In contrast, the finances of many households are under very real pressure from high inflation, including higher rents. They're under pressure from rising interest rates and from falling housing prices. So it's a really challenging environment for many people at the moment. We recognise that the full effect of the higher interest rates is yet to be felt, with some borrowers still benefiting from low interest fixed rate loans. In total, there are around 880,000 loan facilities with fixed rates maturing this year. These loan facilities have an outstanding value of around $350 billion. These borrowers will face a very significant increase in their loan repayments when they move from the fixed rates to the variable rate loans. Now, it does remain to be seen how these various influences on household spending balance out, and there are still plausible scenarios in both directions. The pool of extra savings isn't spread evenly across the population, and it's more concentrated in households with higher incomes. And it's not clear whether these households will want to spend these savings in coming months, or whether they really see them as part of their long-term wealth to be spent gradually over a long period of time. And it's also possible that the resilience evident in household spending on services recently is simply because this was the first holiday period for 3 years that COVID restrictions weren't in place. If what we've been seeing recently is extra spending as people enjoyed their usual freedoms for the first time in 3 years, a period of belt tightening could now follow. But it's also possible that the extra savings and jobs are giving part of the population sufficient confidence to keep spending, just at the same time that other people are finding things very difficult at the moment. So it's a really complicated picture at the moment on the household side. The third uncertainty that I want to highlight is around price and wage expectations. If people expect high inflation to continue, then it's likely to continue, with the higher inflation expectations reflected in wage settlements and firms' pricing decisions. So it's important that people expect and believe that high inflation is only temporary. Currently, inflation expectations remain well anchored, and aggregate wage outcomes are not inconsistent with inflation returning to target. If either of those things were to change, we would face a much more difficult environment. Now, returning to the outlook for interest rates. Based on the currently available information, the board expects that further increases will be needed over the months ahead to ensure that inflation returns to target and that this period of high inflation is only temporary. How much further interest rates need to increase will depend upon developments in the global economy, how household spending evolves, and the outlook for inflation in the labour market. The board's very conscious that there are risks in both directions. It meets every month, which gives us frequent opportunities to evaluate how these various risks are evolving and to respond flexibly as appropriate. We will do what's necessary to make sure that this period of high inflation is only temporary and that inflation returns to the 2 to 3% target range over time. On a completely different matter, earlier this month we announced that the Reserve Bank Board had decided to update the Australian $5 banknote to feature a new design that honours the history and the culture of the first Australians. This new design will replace the portrait of the late Queen Elizabeth II. The other side of the note will continue to feature this building and its forecourt. Given the national significance of the issue, the board decided to consult the Australian government before it made a decision. In response, the government indicated its support for a design that honoured the first Australians. The new note will continue the RBA's proud tradition of having first Australian imagery on our banknotes. Some of you might recall the $1 paper banknote issued in 1966, and you might recall the $10 polymer banknote issued in 1998, both of which featured the art and culture of First Nations peoples. And our new $5 note will continue that tradition. Australia's coins, which are produced by the Royal Australian Mint, will continue to have the image of the monarch on one side. The RBA is now embarking on a process of consultation with First Australians on the new design. We anticipate it will be at least a couple of years before the new banknote is ready for circulation. Until then, the current $5 banknote will continue to be issued, and it will still be able to be used once the new banknote enters circulation in a few years' time. Thank you very much for your attention. I think next time we meet, the review into the Reserve Bank will have been completed and published, and we look forward to discussing the results and the recommendations of that review with you. Today, my colleagues and I are here to answer your questions. Thank you.
Thanks, Governor. Before asking some questions in relation to monetary policy, I just wanted to ask a follow-up question in relation to the Barrenjoey lunch. This was something that you've discussed with the Senate Economics Committee on Wednesday. I just wanted to ask a question to clarify, in a sense, perhaps you might say lessons learned. Would it be fair to say that going forward, the lessons learned from some of the follow-on from that meeting is that it would be best for the bank to discuss matters relating to monetary policy, particularly if it contained potentially market-sensitive information in public forums, before engaging in non-public forums?
Well, the main message I've taken away from this, and we've changed our practice, is that we shouldn't speak in private forums before the statement of monetary policy is released. We've got a blackout period that currently exists for essentially the week before the board meeting, where none of the staff will meet with people in financial markets, because we don't want to give kind of signals inadvertently about what we're likely to be doing. We had thought that it was okay to speak after the decision had been made, but some people in financial markets think that, and I understand this, we shouldn't speak until after the statement of monetary policy is released, because it contains a full articulation of the forecasts and the logic. So we've changed our practice so that we won't speak. Well, the blackout period is essentially longer now. We won't speak until after the statement of monetary policy is released. But,
Okay.
we will continue to talk to the private sector. I feel very strongly about this. We can't live in a bubble in our building in Martin Place. We've got to get out and to talk to people. We've got to hear what they've got to say, and I like asking people questions as well. So we've got to keep doing that, but I accept that people find the timing curious, and we've changed our practice in response to that.
No, I think that's a sensible change of practice. And I think most people would probably agree that it's appropriate for the bank to engage in a range of forums, including with market participants. I suppose one follow-up question I had was, I think some of the discussion that you've had both in the previous estimates hearings and elsewhere is whether or not bond market yields had moved during the course of that day, and I think that's something that you'd said the bank had looked at. Has the bank examined whether bond yields have moved during previous non-public engagements with market participants in the past?
We haven't, because this issue has never arisen before, so it hasn't. No one's suggested that that's been the case in the past, so we haven't kind of started an investigation into every previous appearance. Just to, can I repeat the main point I made at the Senate estimates? The bond yield started moving around 12 o'clock on that day, and I didn't arrive at Barrenjoey until 12:30, and I really didn't start speaking until nearly 1 o'clock. And the movement in the Australian market was exactly the same as the movement in the New Zealand market during those hours, and over the 2-day period the movement in yields was in Australia was pretty much the same as in the United States. So I know people find the timing coincidental, but the work that we've done suggests that it's not always as it looks.
So just on monetary policy, obviously the issue of the day, you've said that half to three quarters of inflation is due to factors that are originating from overseas, obviously what's going on in Europe and how it affects energy prices and supply side issues relating to supply chains. Do you think that that global element of inflation is currently unwinding to a degree due to the fact that, firstly, some supply chains are being repaired, and secondly, that while energy prices remain elevated, the rate of increase has slowed or tapered off?
Certainly that's the case, and global shipping costs are pretty much back to where they were before the pandemic and the Russian invasion. Most commodity prices are back to where they were a year ago, and delivery times and wait times are back to normal as well. So there's a normalisation of the global economy taking place, and you're now seeing that in the inflation figures in most advanced economies where goods price inflation has slowed down a lot. What we noticed, though, in Australia in the December quarter was that that same pattern wasn't evident here. We didn't see in the December quarter a moderation of goods price inflation in Australia. It was occurring elsewhere around the world, but it did not occur here. So we ask ourselves why that is, and we can come up with possible explanations, but the most credible explanation is that demand was very strong here in the December quarter. So the price of clothing and footwear in the December quarter was up 2.2% in one quarter. The price of non-durable household goods, 2.3%. So durable goods prices were still rising strongly in the December quarter. That wasn't the case in many other countries, and it's not the price in global markets. We're expecting that as we move in the current quarter and next quarter, we'll start to see those lower rates of inflation in durable goods. We know firms are paying less in global markets for these, and we'd expect that to be reflected in domestic prices pretty soon. So it was quite a big surprise in the December quarter that we didn't see that. The other surprise that we saw in the December quarter was that the prices of many services were rising strongly. The price of restaurant meals up 2.1% in the quarter. The price of domestic travel and accommodation up 7.5% in the quarter. When we try and unpack why that is, it's because there's strong demand. There was strong demand. We could go on holidays for the first time in years, and people could go with family and friends at restaurants, and prices were going up. So while the supply side factors have been an important driver of inflation, the outcomes in the December quarter had a very strong demand element as well.
So just looking at monetary policy in an overarching sense, the final paragraphs of the December and February monetary policy decision statements were quite different. In December, the RBA said in its final paragraph, the board expects to increase interest rates further over the period ahead, but it is not on a preset course. In February, the RBA said the board expects further increases in interest rates it expects further increases in interest rates will be needed over the months ahead to ensure that inflation returns to target and that this period of high inflation is only temporary. Now, these aren't inconsistent, but there's a difference in tone and emphasis, some would say. Does the change in wording reflect a changed understanding of macroeconomic conditions? And if so, what caused this?
As you said, the two statements are not inconsistent. I would describe it as kind of an evolution rather than a revolution, which is when you read some of the financial market commentary, I think it was a revolution. But anyhow, it really largely reflected the outcome in the December quarter CPI. We had expected underlying inflation to be around 6.5, and it turned out to be 6.9. That's a big difference. And as I said, when we went through the details about what was driving that, we could see areas in the economy where there was strong demand, and that was pushing up prices. And given there's a significant demand element to inflation, We need to respond to that with further monetary policy tightening. We wanted to make that clear to the community, that we were not done yet. We need to take this measure to get inflation down. And that evolution we saw in the language was to reinforce that point. And as difficult as it is, I think the community now has a fuller appreciation of the task that we have and hopefully our resolve to complete that task.
So on that point, you've said that the board is seeking to return inflation to the 2.3% range while keeping the economy on an even keel, and noted that the path to achieving a soft landing remains a narrow one. As a representative of a community with a lot of vulnerable households, I see it as crucial that we balance the goals of not causing undue pain in the community on the one hand, and on the other, that we do reduce inflation fast enough that it doesn't become baked into expectations. How do you see the balancing of those goals?
Well, they're both incredibly important, but what I do know is if inflation does stay high, we won't be able to keep low unemployment and we won't have low interest rates. So right at the moment, that has to be the priority, to get inflation back down and have a credible path to getting it back down. Because if we don't do that, unemployment's higher and interest rates higher, and those gains that we've had in the labour market in the last couple of years, we lose. So we need to get inflation down. And if we don't, then life is going to be much more difficult for everybody. It's a difficult message, and which I think we can keep on that narrow path, though. It's possible if these supply-side problems continue to be resolved and the lower pricing global markets flow through into Australia, as we were discussing previously. If that happens and wage and price expectations remain reasonable, we can travel that narrow path. So we cannot allow inflation to stay high. We'll all pay a serious long-term cost. We'll have lower growth, more unemployment and higher interest rates. We don't want that. So
one of the challenges of walking that narrow path is the uncertainty, and you've talked about some of the uncertainty in your opening statement. You've indicated, and I think this is broadly accepted amongst macroeconomists, that that interest rate increases generally only have their full impact 12 to 18 months after they're implemented. Given that we are now in February and are not yet 12 months beyond the first of the interest rate increases that form a part of this cycle, how does the likelihood of delayed impacts in the macroeconomy factor into your decision making? Well,
when we prepared our forecast for economic growth and unemployment, as I talked about before, we've got growth slowing to 1.5% this year and next, and that's in large part due to the tightening of monetary policy. And it takes time, and we'll have slower growth next year in 2024 again because of the measures we're taking now. We're trying, it's difficult, but we're trying as best we can to factor those lags into our decision-making progress. We talk about them at every board meeting. There are lags both in the transmission of the cash rate to mortgage rates because of the fixed rate loans, and we could talk further about that today. And then once that transmission to mortgage rates occurs, there are further lags before economic activity is fully affected and inflation is affected, and that process takes a couple of years.
And a related issue to the uncertainty around those lags, as you say, the likelihood of lagged impacts factors into the median GDP forecast, yes. But the uncertainty around that has led to some macroeconomists, while conceding the possibility of a need for further interest rate rises, arguing that the case for pausing has strengthened over recent months. And there are a number of factors that some people point to. One is that we haven't seen the full lagged impacts yet. Second is that we've just come off 2 months of data that are very choppy, December and January, where it's very difficult to disentangle seasonal impacts. Third, that some people, as you've identified, are coming off fixed to variable rates. And finally, that inflation may have peaked and that international factors may be unwinding to a degree. I'm just wondering, how does the RBA factor these considerations in when thinking about the timing of future interest rate rises and whether there should be a pause at a particular point in time?
Well, the points that you make are all valid, and we talk about those at every board meeting, but we also talk about the fact that At the moment, surveyed measures of business conditions are substantially above average and just recently have increased. The unemployment rate is at a 50-year low. The number of job vacancies, while it's come off a bit at the moment in any historical context, is extraordinarily high. And this pool of savings is very, very large. In fact, the excess pool of savings in Australia is higher than anywhere else in the world. And our terms of trade, the price of our exports relative to imports, is almost at the record high we got to in the resources boom. So there are a whole range of positives and negatives, and at every single one of our meetings we go through these and try and sift where the balance is.
But would you agree that the presence of some of those factors at each board meeting would be a consideration in terms of whether to pause and take stock?
There certainly would be. It's the global economy, the strength of household spending, what's going on in the labour market and in the prices data, they're the key kind of variables we look at. And at the moment on each of those there are positives and negatives. That's why I talked about the nature of the two-sided risks. There is a risk that we've gone too far and don't need to do any more, and the economy will slow more than we expect, but there's also a risk that we haven't done enough, that inflation proves more persistent and doesn't come down. And our job is to try and balance those.
In relation to your decision making, you've indicated that you have an outreach program, so obviously you talk to market participants, but you've also talked about the fact that you talk to a number of other types of organisations such as ACOS and others that reflect the way people in households and are experiencing the pain of cost of living but also interest rate rises. So how does the feedback from ACOS and similar kinds of stakeholders factor into your decision making?
Well, each month the team that works with Lucy goes out and talks to businesses and community groups, and they prepare a briefing for the board on what they're hearing, and that's also reported to the senior management of the bank, so we kind of discuss that at our internal policy meetings as well. So there's a lot of consultation through those mechanisms. As I said at the Senate estimates, I get a lot of letters from people. I also get phone calls, and people tell me their stories, and that's factored in as best we can to the decision-making process. But at the end of the day, our job is to make sure that inflation comes down. That's, that at the moment, that's our priority. And we think we can do it in a way that keeps people in jobs and keeps the unemployment rate below where it was before the pandemic, but we've got to get inflation down.
Now, just a couple of questions to finish on the modelling. So, as you've indicated, your modelling indicates a central forecast of 4.5% unemployment by June 2025 and 1.5% GDP growth in the next 2 years. As part of that modelling, do you model the proportion of households that would experience negative equity in that scenario?
Brad, you're probably on top of those details.
Yeah, thanks, Chair. So one scenario that so first of all, just to take stock of where things stand today, so a very, very small proportion, less than 0.5%, half of 1% of loans are in negative equity. When we run a stress scenario, if prices were to fall from this point another 10%, the share of loans that would be in negative equity would be 1%. If house prices were to fall another 20%, the share of loans that would be in negative equity would be around 4%. And a big reason for this is that loans during the pandemic were increasingly written at quite, by historical standards, low loan-to-value ratios. So that has engendered a fair amount of resilience in household balance sheets with respect to their ability to withstand a decline in housing prices without falling into negative equity.
And a related question, do you model how many households in that central scenario, and possibly, I suppose, also downside scenarios, because the central scenario is your best guess, but there's a decent chance of upside or downside. Do you model the likelihood of households going into stress, so a certain number of households with, say, more than 30 or 50% of their cash inflows going to servicing loans or going into negative cash flow? Do you model those kinds of scenarios?
Yes, Chair, we have, and in fact we published a fair amount of information around this back in October in the Financial Stability Report, and there'll be an update on those estimates in early April. What I can tell you is the picture is extremely uneven, which is a theme I think the Governor was picking up on. At the aggregate level, it looks like there's a lot of resilience. When we drill down across the full distribution of borrowers, we see a very uneven picture. On one hand, you've got around half of variable rate owner-occupiers who are more than 1 year ahead on their mortgage payments. In fact, about a third are more than 2 years ahead. At the other end of the distribution, we observe around 10% of variable rate owner-occupier borrowers who have got virtually no spare cash flow after they meet their mortgage payments and their living costs, also have very low buffers, and a reasonable share of those households are low-income households and hence have a limited ability to cut back on consumption because a lot of their consumption
and a geographic concentration of those?
That's right. So the picture is very uneven across households, and there's no question that there's a segment of the community that are hurting now, and that's very likely to continue, and that certainly features very prominently in our internal discussions.
Thanks for your evidence. I'll hand to the Deputy.
Thank you, Chair, and thank you everybody for being here. Forgive me if I've misheard you, but I think I heard a very different use of the word moderation to what I've heard recently. With regard to the December quarter figures, you see no evidence of moderation, but the Treasurer has repeatedly used that word. How do you account for that dissonance of opinion?
I'm not sure that there's a difference there. The Treasurer has pointed out that the December quarter inflation number is likely to be the peak, and I've said the same thing today. We're expecting that inflation will start now declining. It didn't decline in the December quarter. It did elsewhere in the world, but it didn't in Australia.
Okay.
And the main reason for that is demand here has been strong. National income is strong, people have got jobs and they've got savings in aggregate. Now, it's uneven, as Brad and I both talked about, but in aggregate, demand was strong in the December quarter, and that's pushed up prices. I think demand is now slowing, not too fast, but demand is slowing, which is going to take some of the pressure off prices, and we should hope that that happens, and we expect it to happen. I think the Treasurer is making a similar point.
Thank you. Job numbers released by the ABS yesterday showed a second monthly decline in jobs, and I think this probably speaks to the narrow path you're talking about and the fine margins that we have on that. But taking losses for the past 2 months over 30,000 and an increase in the unemployment rate to 3.7, the official rate for January is now above the forecast you released just last week of the unemployment rate gradually rising to 3.6 by June and then not hitting 3.8 until December. So can you give your assessment of the latest job numbers, as you have, but more particularly what a faster than expected increase in unemployment would mean for future decisions?
Yeah, but our overall assessment is the labour market's still very tight. When we talk to firms, they tell us they're still hiring. It's a bit easier to hire than it was 3 months ago, but they're still hiring, they still want to hire, and the number of job ads and job vacancies is still extraordinarily high. It's hard to interpret the last 2 months' employment data because there are some seasonal issues. So if it's okay, Lucy might be able to talk about the issues with yesterday's numbers.
Sure, thanks. Thanks, Phil, and thanks for the question. One of the things that's happened as a result of the COVID pandemic is that a lot of the sort of usual seasonal patterns have gone a bit awry. It used to be people would do their Christmas shopping in December, they'd go on holiday in January, and they'd buy cars in the end of financial year sales in June. And all of those things have shifted. In what we saw in the January numbers for the labour force survey, and I should point out that's the reference period is the first 2 weeks in January. Lots of people go on holiday in January, but because everyone had built up holiday leave balances over COVID because you couldn't go on holiday. More people than usual for a January took leave. So that's one of the things. Hours worked went down. And for some of those people, if they're a casual worker, they're not counted as being employed when they're not working. They're not on leave, they're just not working. So you think of supply teachers, a lot of people do just not work during January, and you see that particularly in the participation rate of women if you look in the seasonally adjusted data. But there's an additional point, and this speaks to the ongoing tightness, perhaps not quite as tight as it was a few months ago, but the ongoing tightness of the labour market is that there were an unusually large number of people waiting to start a job. Now, again, in January, there's normally a spike in those figures, and these people are counted as unemployed in the numbers. And normally, if you follow those people the next month, 70% of them are working. So they were waiting for a new job. And it's always the case that there's a lot of those people in January, but there was an additional 100,000 people waiting to start a new job this January than there were in pre-pandemic Januaries. And so you can think that's probably made a 50 to 70,000 person difference to employment, which we think will come through over the next month or so. So there is a change in the seasonal patterns that is just very hard to look through.
But the
we agree that
might be
the labour market is a bit less tight than it was a few months ago, but we would still regard it as being tight, and this is an area we're watching closely.
Thank you. Just referring to your third area of uncertainty, and it's one that I've probably got as well around wages. And I'm remembering back to our last conversation in September when we were talking about the lag and the difficulty in seeing inflationary figures come through until you have the hard data. Certainly anecdotally, I could give plenty of examples in my own patch and nationally of manufacturing, transport, retail sectors that have seen double-digit increases in their wages and certainly across their paybook. Is there a chance or a possibility that the full increase in what is being paid out isn't reflected in the numbers that you're seeing as yet, or that there's the chance that wage growth is a little bit higher than is currently being reported?
We'll get another is it next week? We're getting another reading of the wage price index, so that will help us.
And then the week after that, we'll get the national accounts measures.
So in the lead up to that, what are is this something you're hearing, obviously through your outreach programs?
Well, we're hearing wage growth has picked up, and certainly when we speak to businesses, a fair number are giving wage increases more than 5% this year. Not as high as the numbers you were saying, but still quite substantial wage increases. What we also hear is firms saying, well, we're giving biggish wage increases this year, but next year we're going back to something that's more normal. The labour market's tight, the wage outcomes have been low for a number of years, so firms say, well, I'll pay a bigger increase this year, but not next year. And you also see that in recent enterprise agreements that have been signed. That's these 3-year agreements of typically having bigger increases in the first year and then smaller increases in a couple of years after that. So if that's how it plays out, I think we can escape a kind of ratcheting up, but there's uncertainty here because the unemployment rate's the lowest in 50 years. We're just not sure how the wage outcomes will respond to it. We've got the highest inflation rate in more than 30 years and the lowest unemployment rate in 50 years. And the highest terms of trade, the second highest terms of trade in 100 years. So there are a lot of things that are at extremes, which makes forecasting even more difficult than it normally is. At the moment, the wage outcomes are not inconsistent with inflation returning to target in a fairly painless way. Let's hope it stays that way.
Indeed, I think we'd all agree. I guess, again, going back to our last conversation about the alignment of monetary and fiscal policy and what we've seen since we last spoke, I think when we September it was cautious but optimistic, I think were your words. Forgive me if they're not wrong, but that's the sort of view, whereas now hawkish certainly has been the adjective described. There's been a change, and you're giving some warnings that there's future interest rate rises that we can expect. So there's a slight change in your stance. At the same time, I guess the description of fiscal policy as neutral in the Senate hearings. Is it appropriate to see a change in that fiscal policy? You guys have clearly seen something that's required the RBA to make predictions of further rate rises, which you weren't doing in September? Is it appropriate to see a change in fiscal policy, a tightening evident there? And I appreciate it's. I'm not asking for direct advice on the government. I'm speaking in general terms for the two to work together. Is neutral enough? It sounds a little bit like being more active might be the appropriate setting.
Well, where monetary policy is restrictive and fiscal policy is neutral. Fiscal policy has other objectives than managing the cycle, doesn't it? So this is why one of the reasons why there's a generally widely held acceptance of the idea that monetary policy deals with the cycle and fiscal policy deals with structural issues. And it's possible to rethink that over time, and I think it's a good question whether that alignment of responsibilities is the right one going forward. But if we were to change it, then it needs a different governance mechanism around fiscal policy, which is a big difference from where we are now. So at the moment, fiscal policy is neutral. It's positive that the government is saving most of the proceeds of the record terms of trade. It would be problematic if they were recycled back into the economy, but that's not happening. The government can take other actions other than managing aggregate demand to affect inflation, and in some areas it's doing this. Where there are problems in particular markets, energy markets is a good example of that, various policy measures can affect prices, and we're expecting that the price caps in the energy market will reduce inflation in 2024 by 0.5%. So that's a direct effect from an intervention in one particular market. The other thing the government can do is free up the supply side, increase the supply of workers and make it easy for businesses to respond when there are shifts in demand, and there's some initiatives in that area as well. So it's management of aggregate demand, addressing particular industries where there are price shocks and making the supply side flexible and expansive. So that's the portfolio of options, and different people in the public and in this building will have different view about what combination of elements of that portfolio should be used. But at the moment, neutral is better than expansive for fiscal policy.
Well, thank you, and thank you, Chair. I'll end my questions there.
No,
Thank you very
time
much.
At the end, we'll return.
Thank you.
Yeah. Dr. Charlton.
Chair. Good morning, Governor, and
Good
thank
morning.
you for your time today. Can I ask you first about whether yesterday's surprisingly soft labour force data made you think twice about the RBA's new guidance that at least 2 more rate rises are needed?
No, it didn't. It's just one piece of information. And as Lucy talked about, there's uncertainty about the seasonal adjustment issues. And we know from other sources that businesses still want to hire workers. The job ads are high, job vacancies are high. So things have tailed off a bit. Late last year, in the middle of last year, the labour market was incredibly tight. It was so hard for firms to hire workers, and there was a lot of turnover. That heat's come out, which is good, but the other indicators we have suggest the labour market's still very tight, and yesterday's data didn't affect that assessment. If we saw another weak one, then we'd have to look at that again, but at the moment it didn't affect the assessment.
Thanks very much. Governor, can I now take you back to the RBA's October board meeting? At that meeting, the RBA took a number of market participants by surprise by increasing interest rates by only 25 basis points, half the 50 basis point rise that many market participants were expecting. In the October board minutes that followed, one of the justifications for that policy was the idea that, and I quote, "Drawing out policy adjustments would also help to keep public attention focused for a longer period on the board's resolve to return inflation to target." What you seem to be stating in that comment was that a slower increase in the cash rate will increase the public's confidence in inflation returning to target by acting over a longer period, which seems to be prima facie at odds with economic theory. I'm wondering if you could just give us some of the background to your thinking on that comment. And secondly, does the RBA have any economic research to support the suggestion that a slower rate of cash rate hikes would give you greater credibility around your commitment to returning inflation to target?
This was just one of the many arguments we discussed at that meeting. One of the other arguments was that the world's very uncertain. I've talked about some of the uncertainties today, and when the world's uncertain, go steadily and consistently is better than going in jumps and starts. So that was at least as important an argument. The one that you were just talking about was something that central banks talk about in multiple forums. Is it better to kind of move interest rates quickly up to some particular level and then just sit there, and for the community to say, well, look, they could be done now? Move quickly, get to a level and then just sit there and people say, oh, well, they're done now, there's no more to come, or to kind of gradually over a sequence of months get to that level. The argument that we were talking about at that meeting is if you're doing it consistently over a number of meetings, it keeps public attention on monetary policy and the seriousness of the task that we have. So it's open to debate whether you should get to a particular level quickly or keep going slowly, and for better or worse, the media focuses on the change in interest rates, not the level. So when we're changing them each month, that gets a lot of coverage, and people, as you know, people focus on it incredibly strongly. If we moved up just in one step, we probably wouldn't have that same focus. I think from my perspective, the more important argument is the world's uncertain. And when it's uncertain, it's better to move consistently and predictably and rather than in big steps. Different people will have different views on that. I think the other argument that was influential in us stepping back from 50 to 25 was we'd already done quite a lot. We'd moved off zero interest rates and we'd done that very quickly. The household sector was feeling a lot of pain from these big increases in interest rates, and having done a lot and got closer to some concept of neutral, then it was appropriate to go at a slower pace. So there are a lot of arguments that affected that decision.
Thank you. I accept that there are a number of reasons behind that decision, but I want to ask you again about that particular reason, which you called out in the minutes. Is there any economic research to support the suggestion that a slower rate of cash hikes would give you greater credibility?
I'm not aware that there is. It's a judgment that it's really a judgment issue. Given the media and the political focus on the change in interest rates, mostly rather than the level, the assessment that we made was that this would keep people focused on the tightening of monetary policy for longer. But I'm not sure there's any evidence that the transmission is different depending upon which sequence you follow.
Yeah. So what I can say, in thinking about a path of getting, up, say, in round numbers, say 300 basis points over a couple of months versus in 25 basis point increments, if you put those paths at the beginning of a forecast horizon with any standard macro model, you'll get almost no difference. So from the perspective of interest rates to observable variables like output and unemployment and inflation, it really doesn't matter. And so the question is, what does that do to expectations? So one of the big variables that's important in a standard macro model is inflation expectations. But there's not a lot of good economic theory about how those expectations are formed, and many models have, quite arbitrary assumptions there. So the argument that was, has been, put in various discussions about whether it's maybe a bit better to go a bit slower, as well as the normal robustness argument that the Governor mentioned in an uncertain world, is the question of whether you're influencing expectations differently by having that narrative in the public mind. I mean, in the end, most people are not paying attention to economic news every minute of the day, and so by having, are you influencing their expectations more with a different path? I don't think there's definitive research on this, but I think there is actually a lot of active research on how expectations are formed, and there would be a credible argument for something like that being potentially influential on expectations. There's no good models of how expectations are really formed.
Thank you. Just putting expectations aside for a moment and thinking about the direct effect, did I hear you say that you think it doesn't matter in your model whether you move more quickly or more slowly?
If you're talking about doing, say, 200 or 300 basis points over 3 months versus over 6 months or 9 months, no, a quarter or two, here and there does not matter. The transmission mechanism is not that big in the near term. So, that's just the reality of estimated macro models. The exact path of where you get to doesn't matter that much, as in the speed of that. What matters is the level that you get to.
So it doesn't matter if you move more slowly or more quickly? Not
a lot. We're talking very small beer.
So a lot of it is about expectations management. And I accept that people will have different views on this, but we discussed that if we kept on moving by 50 basis points, we could more quickly get to the peak rate, and then people would say, well, they're done. And the effectiveness and the focus on monetary policy and our task would be diminished. But it's an issue of judgment, so there's no great science there.
Thank you. Governor, I'm going to ask you about the review of the RBA's approach to forward guidance that was released in November. In August 2019, the RBA board discussed a special board paper on unconventional monetary policy, and that paper recommended state-based guidance to provide flexibility to react to unexpected developments, and it noted a number of risks associated with calendar-based forward guidance. Then in October 2020, you added a more explicit calendar-based element to the RBA's forward guidance, noting that we do not expect to be increasing the cash rate for at least 3 years. My question is about the process leading up to that change between August 2019 and October 2020. Was there a board paper that went to this issue that supported the change in approach to forward guidance?
There were extensive board deliberations, and this would have been covered in one of those, probably multiple of those deliberations. The August 19 paper was largely off the back of the work that I'd done at the Bank for International Settlements. I chaired the Committee on the Global Financial System, and we had done a review of unconventional monetary policies, and I chaired that group, and we discussed with the board the results of that, and so that was a thorough process that we went through. And then the pandemic hit, and in March we took those extraordinary measures, and through the year, through 2020, we were discussing what more we could do to support the Australian economy. And as part of those deliberations, we thought we would reinforce the message that the Reserve Bank would be there to support the economy right through the pandemic. And that led to a change in approach, and that was thoroughly discussed and articulated at the board. It's easy to forget now, isn't it? In 2020, the situation was truly dire. We were being told right through that year that tens of thousands of people would be dying soon, that there were temporary morgues being built in the cities. The unemployment rate would be 15%. Our borders were closed. There was no vaccine for years. People couldn't move around our cities. We were locked at home, couldn't go to work. I mean, it was dire. It was incredibly scary. And our board decided, given that outlook, that we wanted to send a very clear message to the community that the Reserve Bank would do whatever it could do to keep the economy functioning through what was projected to be a very long and costly downturn. Unemployment 15%. And one of the things that we thought we could do was to buttress the state-based forward guidance with being clearer about when we thought interest rates would rise. And to my cost now, we said we didn't think they'd rise until 2024. That was part of a deliberate strategy to send to the community a message that we would be there with you. We would do what was necessary. And we would keep interest rates at these extraordinarily low levels if that was what was needed. And it turned out that that wasn't what was needed. The economy recovered much more quickly. The vaccine came, and here we are. I don't see a mask inside. On a plane this morning, I didn't see a mask at the airport. And we returned to life much more quickly than anyone had expected, and the economy's bounced back quickly. And here we are with a 50-year low in unemployment, not a very high unemployment rate. So the board kind of consciously discussed, there wasn't a paper kind of with the title, should we change kind of the nature of forward guidance, but at every one of those meetings that we're having in 2020, we kept on saying, what more can we do to help Australians through this dire situation? And we did what we thought was right, based on the information we had. Turned out we did too much, and we've had to backtrack. It's kind of difficult, and I'm getting a lot of pushback on that, but given the information I had at the time, we wanted to do everything we could.
Yeah, Governor, I acknowledge there was an enormous amount of uncertainty, and so I'm not second-guessing the decision, but I do want to ask about the process that led to the decision. What position did the RBA staff put on time-based forward guidance?
The staff, well, before each board meeting, we have a discussion. I have a discussion with Lucy's group, with maybe 60 or 70 economists, and then the senior management of the bank, probably a group of 25, have a discussion, and the positions that were put to the board came out of those discussions.
And were concerns raised because an expected recovery might require the forward guidance to be abandoned?
We did discuss that possibility. We assigned, turned out to be incorrectly, a fairly low probability to that. Given what we're hearing on the medical side, and given how we're all locked at home, and they were saying a vaccine would be years away, and so we talked about the possibility things could bounce back, and if they did, then we'd have to walk back from that. And we discussed which would be the bigger error. I wanted to do, and the board wanted to do, and the staff actually wanted to do everything we could do to help the economy, get interest rate low, the TFF, the Term Funding Facility, and the bond purchase program. We did all that, and we told people that we would keep interest rates low for as long as they were needed, and that was probably 2024. So that was a view that I would say the vast majority of staff supported. Economists always disagree, so there's always people on the other side, and there would have been a few people on the stake staff who think, well, we've gone too far, but the board judged that was best to make the mistake of doing too much and having to walk back than sitting there and thinking, oh, we just didn't do enough. Too many people lost their jobs. The economy was too weak for too long, and we talked consciously. I said, I did this, and I talked about the senior management quite a lot. Better to do too much and have to walk back, as embarrassing as that is, than not do enough and see people needlessly in unemployment and harm. But now I get a lot of kind of criticism for kind of saying that, but at the time, given the information we had, I wanted to do everything that I could to help the country.
Thank you, Governor. I'll hand back to the Chair. Thank you.
Thanks, Dr. Charlton. I'll hand now to Ms. Spender.
Thank you, Chair, and thank you, Governor and the representatives today from the RBA. Appreciate your time. Look, I want to start, with just a discussion about the implications of long-term inflation and what that would mean in terms of unemployment and wages. So my question is, if inflation persists at this very high level, what are the implications for the unemployment rate if we were going to try and get it down if it persists at this level?
Well, all the evidence from the 70s and the 1980s is inflation stays high for a run of years. To get it back down again, to get inflation back down 4 or 5 percentage points, requires a steep downturn in the economy and probably a rise in unemployment of 5 percentage points. That's what happened.
So about
5 percentage points.
So about 1 to 1, yeah.
Yeah. So the unemployment rate goes from at the moment from 3.5 to 8.5 or 9. So that's what happened in the United States. It happened in Australia. It happened in some European countries. that's the cost you've got to pay to get inflation back down again, and that comes with high interest rates as well, because the reason the unemployment rate goes up is interest rates rise. So it's very costly if inflation gets entrenched, and we really, really want to do that. And part of our communication and the change in February was to reinforce that point to the community. This is serious. We think we can do it, but it's, if we don't, then we'll all pay a cost. It's a big cost. So that's just the cost of getting inflation down. And then we know if inflation stays high, then people have to spend time protecting themselves against inflation. So that takes resources, and that's inefficient. And people on low incomes find it very hard to protect themselves and their savings from inflation. So it really, really hurts people on low income. So high inflation hurts a lot, and getting it down hurts even more. That's why we need to kind of have we've got the opportunity to get it down fairly painlessly, and we need to take it.
And what would be the implications for real wages under that sort of circumstance as well? We talked about the unemployment costs, but what are the sort of real wages implications of those periods, of that sort of drop sustained?
They're poor. I mean, the unemployment rate goes up, people lose their jobs, real wage growth is slow for a number of years. That's the historical evidence, and if inflation were to stay high, I think that evidence would repeat itself, and we better learn from it.
Talking about learning from the past, that late 80s, early 90s time was another time where there was a great increase in interest rates, which didn't seem to affect the economy quickly, and then suddenly we did have a very deep recession.
Yep.
Are there any lessons from that sort of interest rate sort of period, as that we had? Obviously there was much higher inflation at that level, but are there any lessons from that period in terms of the lags that monetary policy the lags required to get monetary policy to affect the real economy that you're taking for this one?
Yep. I mean, it's clear there are lags. We knew that before, but the experience in the 80s reinforced that, and that when we run our economic and econometric models, we use data from that period. So we have a reasonable sense of, at least on average, what the lags are, and that earlier period informs it. The lags are kind of changed through time, though, because one of the things that's different now is people have a lot more debt. So that, what we refer to as the cash flow channel, the reduced cash flow that people on mortgages now have because of higher interest rates, that I think is more powerful than it used to be, because the level of debt relative to income is, twice as high as it used to be. So that channel is more powerful. But if I can take this opportunity just to remind everyone, that's not the only channel of monetary policy. There's a lot of focus, understandably, on people with mortgages, but monetary policy also works through changing housing prices, the exchange rate, firms' investment plans, and the incentive that every single person has to save and invest. If you're getting 4% in the bank rather than zero, your incentive to save and invest is different. So there are a lot of these channels through which monetary policy works, and they all take time. And that's a strong lesson.
A question then, a sort of broader economic question. A number of economic reforms could increase productivity and output and enable structural change within the Australian economy. You mentioned before that the government, so fiscal policy is normally more structural, and things like changing the tax mix away from income towards consumption, significantly easing new housing supply, enhancing liberalisation of labour markets, and increasing public spending, sector productivity, ways sort of potential reforms for productivity and output. What would be the implications of those sorts of reforms on monetary policy?
Those reforms affect things over a longer period of time, don't they? So I note the Productivity Commission has just completed its 5-year review on how to lift productivity growth, and the Treasurer has that on his desk and says he'll release it soon, so I hope that has lots of good ideas for us. But if we can lift productivity growth, then we'll have stronger growth in real wages, we'll have higher real asset values, government finances will be in a better position. It's something I talked about at the Senate the other day, that the the opportunity here is to increase the size of the pie so that all the services the government wants to provide to the public can be delivered. And we can increase the size of the pie but through some productivity reforms. So in terms of monetary policy, it doesn't have most of the time near-term impact, but if we can have stronger growth and a more robust economy, then on average we'll have higher real interest rates. So savers will get higher returns as well. Workers will get higher returns, savers will get higher returns, the government will have more revenue, we'll enjoy higher real asset prices. So better get on with it, and I look forward to reading the 5-year review from the Productivity Commission.
Thank you. Just coming back to an earlier question that was asked, from a theoretical point of view, again, we're a small open economy with surging inflation and a tight labour market. What is the optimal sort of theoretical fiscal policy stance?
It's a very hard question because it depends how you think about fiscal policy. If you say fiscal policy is really just to deal with structural issues, then fiscal policy needs to continue on repairing the budget and getting it back into reasonable balance, and monetary policy is the swing variable. So that's the way that economic policy works in most countries. One reason we ended up in, or two reasons we ended up in that position is it's hard for the political class to take the short-term decisions to manage the cycle. We're raising interest rates. I can tell you it's become very unpopular. It's easier for me to be unpopular than maybe from some people in this building. So there's that element, and there's also the argument that fiscal policy is not particularly nimble. If, for the sake of argument, and not proposing this, we decided that aggregate demand should slow down now and fiscal policy should be used and taxes should be raised. Just be clear, I'm not advocating that, but let's, in principle, decided that was the route we were going to go down. Legislation would have to be drafted, debated through the House of Representatives, through the Senate, there'd be Senate committees. I mean, the process would take time, it would be contested, and those changes in tax rates might cut across some structural issues as well. So that's in contrast to the Board of the Reserve Bank, which meets on the first Tuesday of every month, looks at all the data and can take unpopular decisions in real time. So in theory, you could have a different world with a different governance mechanism about fiscal policy for counter-cyclical purposes, but no country in the world has been able to do that. A, because not really popular, and B, it's hard to kind of devolve responsibility of fiscal decisions away from the political class, as it should be. So,
But are there things that policymakers can do to better manage across the cycle as policymakers? And part of our job may be to do things that are occasionally unpopular, just because, rather than leave it all to you. But are there other things that we can do to help manage, as policymakers across the cycle?
Well, the first thing is do no damage, don't make things worse, and that's why I'm encouraging to save the benefits of the terms of trade. Thinking the design of various programs, making sure that there are reasonably strong counter-cyclical elements in fiscal policy, so things that automatically happen. And the Australian system does have a reasonable degree of automatic kind of fiscal elements that kind of work. So that's what we can do. It's a much harder task to move, ultimately, tax rates and spending decisions in a counter-cyclical way for the reasons I talked about. But there are opportunities, which I mentioned earlier before, to address problems in specific markets, and the energy market is one of those. It's required some fiscal expenditure, but not a huge amount, but it has had a material effect on inflation in 24. So.
Thank you. Then just moving on to a sort of different topic, so the non-accelerating inflation rate of unemployment. I'm just interested in what you've learnt about the Nauru through the present period of very low unemployment. And, would you have done anything differently sort of with that 2020 hindsight, with this knowledge?
What I've learned it's a slippery concept. but I knew that anyhow. But Lucy's and her staff, their job is to kind of pin that slippery concept down. So if Lucy could just say a few words.
Sure. Obviously, our models do require estimates of the NAIRU and trend growth and some of those other so-called star variables in order to form a more medium-term view. I've previously in this committee said that we thought that the NAIRU was somewhere, but in the high 3s to low 4s. I think the evidence that we've seen with how quickly wages growth has picked up, it's probably in the low 4s more so than the high 3s. So we are. I think it's manifest that we are below the NAIRU at the moment, but the NAIRU does move, and I think one of the things that's our staff view. That's what we put in for our forecasts. But I have to tell you, if you use a standard conventional model to model these things, what you see, that they're not designed to handle the supply shocks that we've seen over COVID. So if you just put recent data into those sort of models, you'd get a much higher number, and we don't think that's right. So we've actually sort of looked at what else we've seen and what we saw pre-pandemic, and so at the moment the numbers that we're looking at are in the low 4s.
So what models do you use if you're saying that you can't, use a standard model for the NAIRU?
Well, the standard models for the NAIRU, are basically very demand side oriented. They say, if wages growth is picking up, if inflation is picking up, therefore we must be below the NAIRU. Now, of course, what we saw particularly through last year and the year before was wages growth was only just starting to pick up through last year. But in 2021, we certainly didn't see any pickup in wages growth. But we did see a big surge in inflation for all the overseas supply-based reasons. But of course, the model doesn't know that that's a supply-based thing. It says, oh, look, inflation has gone up, therefore we must be below the NAIRU. And so that's the issue. And of course, at the time, we had quite high unemployment because of all the lockdowns. And a standard model is all about the demand side. And so, the whole range of economic theory hadn't contemplated the concept of a lockdown and what that might do and how you might adjust for that in these sort of standard sort of Phillips curves based models. I mean, it's something we're trying to think through how you would deal with that because typically these models are very focused on the demand side more so than the supply side.
Could we make this the final question, please?
Yeah, sure. That's fine. The last question is about it's about the interest payments that that the RBA makes on excess settlement balances. There's an article this week from Dr. Isaac Gross from RMIT, and the argument is that this costs the taxpayer about $14 billion. And just wanted to ask, what's the rationale for the rate of these payments, and could we get these at a lower cost?
The long-standing practice is that we pay a rate of interest on these settlement balances that's below the cash rate target. At the moment, we pay 10 basis points below the target, and that's been a long-standing element of our system. If we were to increase that margin, and let's say paid 1 percentage point below the cash rate target, that would effectively act as a tax on the banking system, because the bank's got these balances with us and we'll be paying a substantially lower rate of the market rate of return. So no central bank does that. The monetary policy works best if the rate that you remunerate balances at the central bank is close to the market rate. It's not inconceivable to do it a different way, but it would be a very different model. It would be kind of viewed as a kind of form of tax, and it would distort the operation of our capital markets. So.
Thank you.
Thanks, Ms Bender.
I'll hand back to the Chair.
No, thank you very much. I now suspend proceedings for a short break so that the RBA can have a cup of coffee potentially, and we'll resume at 11. Thank you.
rent increases aren't because interest rates are going up. I'd just like to read some comments I received from constituents following our hearing last year. First one is, I recently renewed a lease. The same properties in the same building on a new agreement are 20% higher than my apartment. Agents are saying it's because owner expenses have increased. Another comment I received was, my real estate agent blanket emailed all their tenants saying the landlord could no longer afford the same rent due to increased costs. They tried to put mine up $80 a week. So out there in the suburbs, it's pretty clear that rents are going up because of interest rate rises. But here in this building, we hear the opposite. So which is it?
I think we're both right. And I say that because many landlords I know are saying to their tenants, I'm putting your rent up, and they're saying interest rates are up, so I've got to put my rent up. So they say that, and that's true. But they can only do that if the market allows them to. You can only put your rent up if there's a shortage of rental accommodation and the tenant can't go elsewhere. And all our work suggests that it's the vacancy rate that explains most of the movements in rents. So that's what the underlying economics is. The explanation that the landlord gives the tenant is, I'm putting your rent up. It isn't because the vacancy rate's low, I can extract more rent out of you. But you can't put your rent up if there's a lot of vacancies, because the tenant will ultimately go somewhere else. So both perspectives are right, and the critical issue here is the lack of rental accommodation. That's what's driving higher rents. It's not higher interest rates. Higher interest rates is the explanation, but the underlying reason is that there's at the moment strong demand for rental accommodation, and there's not enough rental accommodation on the market. The rental vacancy rate in Sydney is kind of back to kind of where it is most of the time, but starting to push lower, and the rental vacancy rate in most of the other capital cities is way below where it has been on average, and rents go up when there's not enough supply. That's the fundamental issue. So, we're both right. I'm not saying that higher interest rates don't have any effect, but they can only have an effect because of the supply imbalance in the marketplace.
Well, the answer you've just given there seems to be at odds with some of the other comments you've made, so that's why I sort of asked the question again.
Yeah, so it's a fuller
Right.
kind of, so that's why if I said I probably didn't wasn't expansive enough last time, because I've got in my, it's basically the vacancy rate that determines rents.
Right. Again, going back to September, your evidence to this committee revealed that in your considerations when you look at raising rates, that you measured the dollar impact of those rises on those with a mortgage, but your evidence suggested that you didn't do the same sort of dollar for dollar analysis for renters. The highest form of housing tenure in New South Wales are now renters. Yep. Have you since undertaken that dollar for dollar analysis on the impacts on renters since our last meeting?
Well, we know rents are rising quickly, and we calculate how that affects household budgets, and our focus really has been on those households that are paying more than 30% of their household disposable income in rents, and they are prominently, mostly lower income households. And with rents going up at, we're at 5, but the new rents are probably going up 10. That's if you're paying 40% of your household disposable income in rent, and it goes up 10%. That's a really large and first order impact on people's finances. And we do those calculations. Yeah, I know it's really tough when rents are going up so quickly. But the point I keep circling back to here, because I think it's underappreciated, is it's supply. And we need to do more to increase the supply. That will help.
Do you know if the impact of a rate rise is higher or lower on renters than it is on mortgage holders?
It's higher on mortgage holders. Obviously depends upon the size of your mortgage. If you've got a $500,000 mortgage and the interest rate goes up, that has a material effect on your outgoing cash. the effect for most rental people who are renting isn't as large. As a share of their income, it can be significant, but the dollar effect isn't as large. And I keep coming back to it's not interest rates that are driving rents, it's supply.
Do you measure that effect on?
Do we measure?
Yeah.
I don't know. Does your team kind of do those calculations?
Not in exactly that framing. I think the way we would frame it is you've got the direct effect on household cash flows from increases in housing costs. And unambiguously, the direct effect on household cash flows, because due to a rise in interest rates and that effect on household cash flows, is larger for people with debt, who are primarily people with mortgages. Renters tend not to have much debt, unless, of course, they also own an investment property, which is very much the minority. Where you do get more of an effect on renters is that, of course, when you have an economic downturn and unemployment increases, and when you have an increased cost of living, those things impinge on lower income households more, and lower income households tend also to be renters. So that's the transmission. It's not the direct effect of the interest rate, it's the overall macroeconomic balance. And I think it's fair to say that low income households are typically find it harder to navigate an increase in the cost of living, and they also find it harder to navigate even higher unemployment that would be needed if we were to not to get inflation down quickly. And most of those people, that group of people are disproportionately renters.
You mentioned even in that answer there, but earlier, the unevenness in wealth savings and the impacts of rate rises. I'm concerned, and the feedback I've got from those in my electorate is that the higher rates are disproportionately smashing renters. And do you think the RBA needs to better understand the impact of rate rises on renters, or are you happy with that? It seems like you've got a different approach to measure it on renters than you do on mortgage holders. Are you happy with that, the current set of data you're getting?
Well, I always want to understand everything better. So if there are ways that we can understand that better, we'd certainly jump at those. But to understand the kind of the mechanisms that we've talked about, that higher interest rates lead to some landlords putting up their rents if they can because of the supply situation, so we can calculate that. And so that's the main mechanism, and we look at household budgets, and if there's a better framing to understand that, then we'd welcome.
Are you seeking better data on the impact on renters? Or are you
I don't know,
just
if
using
you've got
your
idea,
existing-
I'm not quite sure what we're always seeking better data, but I'm not quite sure what the better data is. But
So,
maybe you've got ideas, Lucy?
one thing I can mention is, as part of going to the monthly CPI, the Bureau of Statistics obtained a better data set for measuring rents. They used to do a survey of some thousands of properties. They now have an administrative data set that actually covers hundreds of thousands of properties. And we have sent one of our team into the ABS to look at some of that. So he's currently there, and we're looking at some of the underlying data to do some more splits. So absolutely, to the extent we've got people and time to do it, we are always looking at those things. And I think one other point that I'd make is that's the stock of rents that is actually happening, and that includes people with an ongoing contract. A lot of the sort of the stories that people are hearing is about the newly contracted rental property, so the leading edge. And we know that, we've known for a long time that advertised rents have been growing much faster than the overall stock because they're the leading edge. That doesn't necessarily, we do expect the CPI rents, so the overall growth to pick up. That's already in our forecast. We're aware of that. It's currently around about 4. So that's, again, that an increase of 4 on average for most people is very different from what people on mortgages are currently experiencing in terms of the increase in their repayments. So we can get at those things using different data sets, but absolutely we're looking at other ones as well. And we just, it's never been the case that the CPI rents always catches up to the advertised rents in growth rate terms. It's more just you have, each cohort rolls over, they experience sometimes a larger increase than normal. We are expecting, because of the tightness in the rental market and because of the low rate of vacancies in most places, we are expecting rental growth to continue to pick up.
Okay. Just got a few questions on the Barrenjoey lunch. How many times have you, the Deputy and Assistant Governors, met with employees of Barrenjoey over the last 6 months, including at events hosted by them at the RBA or elsewhere?
Well, I can answer myself. That was the first event I've done for Barrenjoey.
No, I've not done any in the last 6 months.
Okay.
In the last 6 months? I did one after the November. So after the SMP, I always do a sequence of events and lunches and other meetings for, our liaison contacts, various other contacts, and some of the financial markets. And they're not necessarily financial market participants around the table. Oftentimes it's corporate clients. They're often, the most interesting two-way conversations. So I have done 2 for Barrenjoey ever, and I think one of them within the last 6 months. It was after the November SMP.
I had one invitation which I wasn't able to take up.
Okay. Following news of the most recent lunch, it's reported that another lunch with Assistant Governor Ellis was scheduled, but that it was hastily cancelled. Why did you cancel that second lunch?
As I talked about with the Senate Estimates Committee, our liaison with business and with various groups proceeds on the basis that the people I'm talking to, can trust that I don't go to the media and kind of say what you told me or what other people in the meeting tell me as well. There's that kind of trust
off the record
there.
Yeah,
they're off the record. There's nothing untoward about this, but if you speak to me, you want to have trust that I'm not going to go and blab to the press the next day, and I expect the same courtesy. That I can participate in conversations where people don't run off to the press and interpret or misinterpret what I've said. That courtesy wasn't extended after that Barrenjoey lunch, and I decided, given that, we would not be doing further functions for them for quite some time. Now, we need to all be able to, there's nothing untoward here, but we need to be able to have conversations with people without the other side of that conversation running off to the press. And when that happens, it destroys trust. And there are consequences from that. And that was why we cancelled the further functions with Barrenjoey. Trust needs to be built again.
In 2021, the Bank of England, in a bid to raise transparency, scrapped holding these off-the-record private meetings. Have you considered doing the same?
We've talked about it, but we've also talked about the danger of living in a bubble.
Oh, I don't think it's that they're not meeting them, it's that they're no longer off the record.
Well, I don't know. Then they're kind of open to the media and everybody, so it's very hard to then have kind of discussions with people if everything you do is in the media.
But what are you saying at these things that wouldn't want to be made public?
I'm saying the main messages. It's not just me talking. It's the messages. There's questions. So I was asking people there how our message was landing. Not so well. Do they think inflation is going to be more variable in the future, and why, and how monetary policy should respond to that? I think I was talking about the Reserve Bank review and what they would like to see. So there's kind of it's not me just answering their questions. I'm asking questions, and it's kind of an interaction, and I learn a lot from that. I think it was in public, then it wouldn't be as valuable to me. I feel like the Reserve Bank is speaking publicly more than enough, and to replace all the private events with public events, I think it would be a retrograde step. But I accept that other people have different views, but I worry about us not talking to people enough.
So you said you considered stopping those type of events?
We talked about it in the management group. We said, well, look, is this something we still want to do? And for the reasons I just went through, we decided we still did want to do it, but we would not we'd extend effectively this blackout period, and we would not do them just before the SMP. And if I was going to give a major speech straight after a board meeting, in the following days after a board meeting, then I wouldn't do one either. So it's balance. Yeah, we've got to talk to people. We've got to hear what they've got to say and learn from them.
I'm not suggesting by any means you don't talk to people, Governor, just to make that abundantly clear.
Final question.
Okay. Look, in my short time here, I've sort of noticed a frustration at the lack of communication from the RBA to the public and to markets. Prior to Wednesday, you hadn't made a public statement since before Christmas. Reports have called the lack of public speeches as an information vacuum, and in an email to clients, the NAB said there's still a conspicuous lack of scheduled speeches from Martin Place. In your evidence to the Senate, and just now you said that you had received feedback that you're perhaps talking too much. Do you feel that you need to work on your communication with the public? Not you personally, but maybe you personally.
Personally I do,
is that something you reflected on?
No doubt this will be something that will be covered in the review, and be kind of looking forward to what they've got to say. But if I can just go through kind of the last week with you as well. In the previous years, maybe the 3 or 4 previous years, I've started them by giving an address to the National Press Club the day or two after the board meeting, and then a day or two after that appearing before this committee. So that would have been 2 public appearances in the first week of February. I think in January people don't want to hear about interest rates, so put January aside. One piece of feedback that I thought it worked quite well doing those 2 events in the first week of February, but one piece of feedback that I'd had was, why are you speaking to the press and answering their questions 1 or 2 days before you're speaking to the parliamentary committee? There's a 3-hour hearing, good questions answered, detailed questions. The media questions some are good, some are not so good.
Still got a few more here, we don't know.
And I thought about that, and I thought, well, why am I speaking to the National Press Club 2 days before I'm speaking to you? And I decided, at least this year, that probably wasn't the right thing to do. And normally this meeting would have been scheduled for the last Friday. It's normally on the day, the practice has been the day the statement of monetary policy comes out, and that I thought that worked really well, and I wouldn't do any other public comments. For the reasons to do with the calendar, it got pushed back a week, and so then we didn't have anything last week. I decided not to do the National Press Club because I thought we were going to be here last Friday, but we got pushed back, and then I had a kind of a gap in my diary, and I thought I wanted to go and hear what other people have got to say about what we're saying. So that's how we ended up where we are, and it's a good question about what we should be doing going forward. From my perspective, it would be better to have this hearing on the day the statement of monetary policy comes out. It's very close after the board meeting, and I wouldn't do any other public events between those 2. But that's not always possible because of scheduling issues. So. But the review will no doubt give us advice. I mean, some people say that I should do a press conference after every meeting. There'll be 11 press conferences a year, the most of any central bank governor in the world, and all the other speeches. And before your committee twice a year, and the Senate estimates want me 3 times a year. Some might say too much.
You're in demand.
But I'll leave that to others.
Thank you.
Thanks, Mr. Luxall. I'll hand over to Mr. Van Manen.
Thank you, Chair, and thank you, Mr. Lowe and the rest of the team for your comments and answers to our questions this morning. It's been a wide-ranging discussion. I first want to start off with trying to understand from a definitional point of view, you're targeting a long-term inflation rate of 2 to 3% on average over time. What is that time frame? Is it 12 months? Is it 2 years, 3 years? Because if you have a look at a long-term rolling average, say over the last 5 years, which is what I would consider medium term, the inflation rate currently over the last 5 years sits at around 2.7 approximately to the end of December, albeit there's been an uptick in that average obviously over the last little while. So if you're targeting that rate over the medium term, why are we in the situation that we're in now when you're targeting the inflation rate that is well understood to be driven by a number of factors in the short term, as opposed to your medium term outlook, if that makes sense?
Well, the year we've just gone by, we've had inflation of 8, and this year we expected 5, and then kind of bit above 3 the following year. So we don't have kind of a precise definition about what the averaging period is. I think that misses the point. What we're trying to do is to make sure that over longish periods of time, Australians believe and accept the idea that inflation will move around 2 to 3%, and that when it gets hit away from that number, it'll come back. And that's what we're trying to do now. And I think we're going to have to get used to more variability in inflation than we've had in the past. And I talked about this in a speech late last year, that for the past 20 years, we got used to inflation kind of being in a very narrow range. And at previous hearings of this committee, I remember being berated because inflation was half a percentage point away from where it should be. You know, that was the world we're all living in. I think that was a special period, and we're not likely to be in that period again. We're moving into a world, because of a whole bunch of reasons we could talk about, inflation's going to move in bigger cycles, and what we're trying to do, and what we will try and do in that world, is to make sure that when inflation moves away from 2 to 3, it comes back, and people believe it comes back. And in a way, this is the first big test. You know, we used to worry 0.5%, but now we're kind of 5 percentage points away from where we should be. And this is the first test, I think, of a new reality that most central banks are going to face, that inflation is more variable because there'll be more supply shocks, weather events, climate change. There are less globally integrated global economy. So inflation will move around more, and when it moves around, it's going to come back to 2 to 3. This is the first chance we've got to show that's going to happen, and we're going to make sure it happens. So that's what we're trying to do.
Right, to follow on from that, then, the next obvious question is, you've made it quite clear in comments to this committee earlier today, but also in other settings, that and acknowledging the lag between the decisions you make and the economic impact. Given, as you've just outlined, we're going to have, pardon me, more variability and potentially other shocks that we currently can't identify. But do you, as a consequence, do you have the tools and the data capacity to manage that in a much more timely manner and in a much more fine-tuned manner than you currently have?
Well, we do the best we can. Our tool is the interest rate. That's the tool we have. We don't really have other tools.
Rather than focusing on the interest rate, I'm talking more about the tools to identify those issues before they occur, so as to minimise the need to use the interest rate tool if that's possible.
It's a good question, and we'd always like more data and kind of understanding of what's going on. So we have interest rate as one tool. The other tool is what we say, and I've been doing that today and this last couple of weeks. And what we're saying to people is, if inflation moves away from the 2 to 3% range, you should be confident it's going to come back down, and the central bank will make sure. So that's a tool we have. Because if we weren't saying that and we said, well, inflation's 7 or 8%, we're not really that worried about it, it'll be okay for a while, then that would get factored into firms' decision making and to wage outcomes, and it would stay high for a while, and then we'd back into the world that I talked about with Ms. Spender. So that's a tool we have. Whether it's effective or not, it's hard to tell.
So on that basis, and given your response to that question, what then discussions are you having with government or with Treasury, for that matter, in regard to how fiscal policy can fit or dovetail into that necessity to keep inflation in that band, given your concern that we're potentially going to have other adverse events, so that fiscal policy and monetary policy working together, not in opposition to each other?
All the discussions we have with both Treasury and the government are similar to what we've been talking about before. Save the benefits from the terms of trade, don't recycle those back into the economy, because that will add more aggregate demand. And
does that include off-balance sheet proposals?
Most of the off-balance sheet things aren't really affecting aggregate demand this year. They're multi-year funds, aren't they, that get spent over kind of I don't know, is it 5 or 10 years? I'm not sure. But if those vehicles were used to pump up aggregate demand this year, that would be a problem. But that's not what is being proposed. That's my understanding. So don't recycle the terms of trade boom funds back into the economy. Save them. Largely that's happening. And as I always talk with Treasury and governments of both persuasions, do whatever you can to make the supply side bigger and more flexible.
We've talked at length today about household psychology. I want to switch to the other side of the equation, and that's business psychology. And I know I've asked you this question at a previous hearing about the cost base of our economy being permanently higher now than it has been in the past for a range of reasons. What are you seeing in your discussions with the business sector, and is that part of their thinking in that they've used the current environment to increase the price of their goods and services at a time when there's plenty of liquidity in the economy in preparation for some more difficult times down the track, to give them some fat in their margin, so to speak, to be able to accommodate that?
No, I don't recall any business ever saying they've increased their prices to generate fat in their margins. What they do, the main message we've been hearing from business over recent times is it's hard to get workers. There's a lot of turnover in the labour market. We're having to pay more. Our main challenge is getting workers. Firms have not been complaining about a lack of demand. Most firms have not. They've been complaining about a lack of workers, and for a while they're increasing intermediate input costs, but that seems to have gone away, and they're telling us now it's still hard to get workers but not as hard, and demand is still strong. You see that in all the business surveys, that businesses are saying things are above average. On pricing, well, they don't say this, when demand is strong, you don't discount. If demand for your product's strong, why would you discount? And that's one of the reasons I think why inflation's been high recently, is demand strong, firms don't discount, and some firms, no doubt, take the opportunity to put up their price when demand is strong. That's how it works. The higher interest rates will mean that demand won't be so strong, and firms will once again start discounting, and prices will have to be a bit skinnier. And we expect that to play out over the course of this year, and that's the process of bringing inflation down. So that's what we hear. But firms don't kind of talk about pricing with us. They normally say our costs are going up, we've got to put our prices up. But we know when demand is strong, you don't discount and you do put your price up.
But given the situation with inflation, because a lot of business leases are linked to inflation, there's going to be a significant increase for a lot of businesses, particularly in the retail sector, in their cost base over the next 12 months as that inflationary effect flows through. What does that do to how does that reflect in the inflation rate and your considerations of what happens with interest rates?
Well, the higher input costs, flow through into final goods prices, which is what's measured in the CPI. But there is an offset, though, because the price of many goods in global markets went up a lot during the pandemic, is now coming down. You see it's kind of in the building industry with some inputs they went sky high, and they're still high, but they're inching down. And in the goods that are sold in department stores, the prices went very high, and now they're coming back down in global markets. And shipping costs were extraordinary. I think they went up to ship a kind of container from China to Australia, kind of went up a factor of 6, and now that's kind of coming back to normal. So some costs are going up more, but others are normalising, and that should be enough with some moderation of demand to bring price growth down. But more discounting and less taking advantage of strong demand will help.
In your testimony to the to Senate estimates during the week, you made the comment about it's terrific to see our banks being profitable, and I don't think anybody here on this committee would argue that we need strong banks. But isn't it fair to say that at this point in time we are seeing, and we saw with the CBA profit announcement earlier this week, a very significant increase in their half-yearly results. That's coming at the expense of borrowers. What work are you doing to try and have that be a bit more balanced, or what can we do to have that be a bit more balanced so that the pain is being shared and it's not all finishing on the borrower, and that the banks and their shareholders are benefiting significantly?
Well, I was reported as saying it isn't terrific, the banks are earning such profits, but that isn't what I said. I said a country which has strong, resilient, profitable banks, that's good for the country. I'm not cheering and excusing the high level of profits, but I think we've got to acknowledge that having a healthy bank system is actually good for the country. I did say I'm concerned about the lack of pass-through of our cash rate decisions into high deposit rates. The banks have, very quick to pass on into loan rates. Most of them very slow to pass on to deposit rates, and they need to do better there. And the inquiry the government has just announced hopefully will put pressure on to do that. The other thing that can put pressure on them to do that is Australian switch. Now, there are bank accounts available at the moment where you need to just put a couple of $100 in a month, that's all, and you'll get an interest rate of 4.5%, and it has full transaction capability. So if you're unhappy with the interest rate your bank is paying, go to another one, because there are some very good deals out there. You can get easily 4% above on an at-call, full functionality deposit account, which you can use with all the kind of modern payment methods. So my advice here is switch, and if Australians switch, then the banks have to respond. We were talking about before, when there's competition, firms have to respond. So,
but the pain is being felt by borrowers.
It is. So, and I just kind of that's on deposit, and I just Michelle want to say something as well. But the other point I want to make is on from borrowers. Up until our recent increase, the cash rate had gone up 300 basis points. So 3 percentage point. The average rate that people are paying on their mortgages has only gone up 260. So even though the posted rates that banks have charged have gone up 300 basis points, the actual rates that people pay have gone up substantially less than that. That's because there's competition for new borrowers, and there's discounting, and again, people switching, the banks have to respond. And they're doing that. So of the 300 basis points, only 260 has been passed through into the average mortgage rate. That's because of the competition and switching, and I encourage people to do it on the deposit market as well, and it'll have the same effect.
I was only going to make that point, that actually there is a lot of competition on the borrowing side, particularly for housing. And if you look at refinancing rates, they're really, really high. People are moving. And this is actually, I think, probably a bit of contrast to a few years ago when people didn't really move. They are moving now. I think during the pandemic, people actually had time to sit down, look at their loans and think, I can do a better job of this, and they're carrying that forward. So let's move it onto the deposit side now and start switching there as well, because it works.
There are some good deals out there, and people should hunt them down and take them. And if they do, they'll get better, their finances will be in a better shape. So
I accept that there are good deals out there, but my concern is that over time, if interest rates continue to rise and property prices continue to fall, then the ability for people to refinance is going to be impeded as a consequence of the confluence of those two factors. And so what data do you get in relation to refinance rates to see whether that problem is starting to occur?
Well, it's not starting to occur at the moment. The rate of refinancing is record high.
Okay.
And the banks are competing very aggressively for the existing customers, including some of the people on fixed rate loans who are moving to variable rate loans. So, and this competition has led to a very substantial reduction in the rate of increase in the average variable rate that people pay. I said 260 versus 300. That's people are saving on average 40 basis points on their mortgages from switching. And we don't see any evidence that that's slowing down. Banks tell us they're competing, they want more customers, and they're cutting the price they charge.
My final question, Chair, to follow on from a question that Ms Bender asked just before the break. Our banks have very substantial funds in their exchange settlement accounts. What are your concerns about the inflation rate or the impact on the economy if the banks were to release or use more of those funds and push them out into the economy, and what impact would that have on the inflation rate?
In the past, a big increase in the central bank balance sheet, as what's happened here, would be seen to be very inflationary, because what was people thought would happen is the banks sitting on all these balances would say, I don't want the balances at the central bank, I can find better things to do with my money, invest or lend or kind of do something. And that extra activity would generate more demand and that would generate inflation. But by and large, I don't think that mechanism is currently working, because the banks with the balances at central banks are broadly content with them. They're not saying, I've got this money at the Reserve Bank, I can really find a better deal for it. What we hear from them is they need these balances partly to pay back the term funding facility funds that we've lent to them and to manage their payment flows. So if I can just take the liberty here, because when we were having a half-time break, Brad reminded me that I failed to mention a very important point about these exchange settlement balances. So if I can take the liberty or going to Brad about kind of what would be the problem of if we lowered the interest rate paid on these balances.
Yeah, it would amount to an effective easing of monetary policy, because it would potentially pull the term structure of interest rates lower. We saw this happen. In fact, this feature is inherent in a world in which you've got abundant reserves, which is the world that we've been in since the pandemic and since the bond purchase program took effect. And this weighed, for instance, very heavily in the Federal Reserve's thinking about how it would change whether it paid interest or not on exchange settlement balances. When they started buying bonds, they realised that obviously there are a lot of reserves around, and so they had to start to pay interest, a rate of interest that was linked to the cash rate, very closely linked to the cash rate, to ensure that the system, there wasn't an effective, easing of monetary policy, and that's basically how we've thought about it at the bank. You've got to have, in a world of abundant reserves, you've got to have the settlement rate closely linked to the cash rate. If it's substantially below, you're going to interfere with the transmission of monetary policy.
So just quickly, if I may, Chair. So in relation to that, you've got the term lending facility that's been advanced to the bank. So what's the current outstanding balance on that compared to what they've got in reserves? And what's the interest rate that they're paying on the term lending facility compared to what they're getting on their funds in the exchange settlement accounts?
One of my colleagues got the current balance.
The current balance is 188 billion, and I think there's around about 450 billion in ES balances in total. I think that's about right. And the interest rate that they're paying, some balances they're paying on the term funding facility, some they're paying 25 basis points for roughly 40-odd% of it. For the rest, they're paying 10 basis points, sorry, not 1 basis point, 10 basis points. And the exchange settlement balance rate at the moment is 3.25.
So why are they not paying a similar rate on the term facility to what they're getting on their exchange settlement accounts? Because that's an enormous benefit to the banks, given that everybody else's interest rates are going up, yet their interest rates that they're paying on the term loan facility haven't gone up. It's an enormous piece of corporate welfare.
Well, if you trace through all the channels, though, the people who are benefiting most from this are the people who took out low-rate, fixed-rate loans. Because the fact that we made these 3-year loans to the banks at low interest rates encouraged the banks to make 3-year fixed-rate loans to their customers, and we saw a huge increase in fixed-rate loans during the pandemic at very low interest rates. So the competition amongst the banks ultimately saw our TFF funding flow through into all these low fixed rate loans, which now people are complaining about because they've got to roll over. But those people for 3 years have had very low interest rates on their housing loans, 2%, 2.25%. So that's how it's flowed through.
I think we're going to have to. Okay. Thanks, Chair.
Ms. Lawrence.
Thank you very much for your time, and I have many questions, so my apologies in advance if you feel I suddenly cut you off.
Okay.
But I've received quite a lot of correspondence from people within my electorate raising concerns about where the economy is at. Not all bad. I wanted to kick off with giving you something positive to hear. Rosemary from Stoneville wanted me to pass on a message to you that she and her husband think you are doing a very fine job, and wants, essentially, or wants to convey that, there's obviously a requirement that we all live within our means, and that some people are genuinely finding it tough, but others can learn to budget and minimise on luxury spend. So I'm just curious as to what the actual data is showing you as to, in terms of the cohort that we've been referring to earlier that are obviously adversely affected by the increase in interest rates, how much of their spend, of their debt to income ratio is going on discretionary funding versus non-discretionary funding?
If you're writing back to Rosemary, could you pass on my thanks? Brad, have you got kind of, or Lucy, you've got kind of the financial stability review coming out, which is going to talk about some of these.
Yeah, we're very mindful that that the experience, both in terms of housing servicing costs and then just general costs of living, very unevenly distributed. The experience is really wide across the community. So we certainly do have data, and Lucy's team in the economics department monitor this closely. For instance, if we look at if we break households into 5 buckets by income, at the lower end of the income distribution, households are spending quite a high proportion of their disposable income on housing costs. That tends to be more renters. Mm-hmm. And then a lot of their income also goes on essential goods and services. At the other end of the distribution, you tend to see a lower share of disposable income going on housing costs, because many of those folks own their home outright. And a lot of their consumption is actually discretionary goods. So it's a very uneven experience across the entirety of the distribution. And as I alluded to earlier, not only do we know that renters are experiencing hardship because of the rapid increase in rents, but a certain segment, it's important that I qualify, a certain segment, not all, certain segment of borrowers we think are basically not saving anything at the end of each month. Virtually all of their expenses are going on mortgage costs and general cost of living obligations, and they also have very little in the way of mortgage prepayment buffers, less than a few months. And that cohort's about 8% roughly.
Thank you. Yeah. And do you collect data on the buy now, pay later as an input into the exposure households have? We do.
Yeah, Michelle, do you want to?
Oh, yeah, we do, but it's sort of an informal collection. Buy now, pay later relative to, say, personal debt on credit cards is really quite small. So we do collect some, but we collect it more as an understanding of how many transactions are going through buy now, pay later, and it's relatively, the debt and the transactions are relatively small compared to what's 5%-ish, I think.
But are you able to correlate that, though, to which segment within the sector
we can't. We can only, all we've got is data on total aggregate outstandings, if you like. We have no disaggregated data on that.
The other two pieces of data that we have which are relevant are the share of loans, including credit card loans, that are running late. And the banks say that those shares are almost at a record low at the moment. Partly that's because people got money during the pandemic, but the people are keeping up their loan payments now. That's probably going to change a bit. And the other piece of information we have is the number of personal insolvencies when people get into financial difficulty. That's rising, but it's still low.
So to Mr Van Manen's question earlier about banks being, and to your comments too, being slow to pass on rate rises to savings accounts, I want to know whether you can explain what the actual consequences are on the economy of the banks not doing that, because you did talk about that investment channel of people making different decisions when they're actually attracting a higher interest on their saving deposits, be it personal or business. So what effect is that having on the economy for the banks being so slow, and in fact using it, as I understand, almost as a business model to defer as long as they can of passing on those savings?
We haven't been able to identify any kind of macroeconomic effects from this, but
well, you did mention about $300 billion worth of savings being in an account, so it would be quite substantial, I would have thought.
Well, a lot of that savings is in mortgage offset accounts, which effectively earn the mortgage rate. So though a lot of that $350 billion automatically gets paid the mortgage rate implicitly. But some of it is in deposit accounts, because the people who've taken out fixed rate loans over the last 3 years at these very low rates, the banks tell us that some of them have offsetting deposit accounts where they're saving up money because they're paying low mortgage rates at the moment. So I don't think it has any kind of macroeconomic effects, the slow pass through the deposit rates, but it certainly can have an important effect at the individual level. If you've got your savings in the bank and you're only earning 0.2 and you can earn 4.2, well, you should switch it and earn the 4.2. And
sure. No, I understand that point you made earlier, but I'm trying to understand if we're trying to reduce inflation, if we're trying to reduce the demand on spending in the economy, if, as you say, as an investment channel, people make different decisions if their savings are starting to accrue additional funds, what effect is it having for the banks holding back, passing on those interest rate rises onto saving deposit accounts, on trying to address the reduction of cash in the economy?
I don't think it's having a first order effect. The banks earn more profits, obviously, because they're not passing on the deposit rates, and that pushes up the share prices, and so the people who own shares are slightly more wealthier, but I don't think that kind of affects aggregate spending in the economy that much. So I'm not sure there's a macroeconomic effect here. It's really kind of an individual and fairness effect.
You've spoken obviously about the various lags within the economy, from monetary policy lags. How much of the 325 basis point rise are you expecting to have on the economy, and how much is yet to have a full impact on the economy?
Well, the increase in interest rates hasn't fully flowed through to people yet, has it? Because these 880,000 borrowers who are on fixed rate loans that mature this year, they're yet to feel the impact. So that's going to come through this year, and next year I think there's another 400,000 people with fixed rate loans maturing. So when that happens, their interest rates will go from roughly 2 to 2.5 to whatever the mortgage rate is then, at least 3 percentage points higher probably. So that's a big effect still to come. Even if mortgage rates had moved straight away with the cash rate increases, it takes roughly 18 months to 2 years to have the full effect on the economy. So this tightening that we've done will still be felt well into 2024. And what we're trying to calibrate is how much is enough. And as I spoke about at the introduction, there are risks on both sides here. There's a risk we do too much, and we'll go too fast.
So are you able to clarify what indicators are you looking to see fall or rise in order to make a decision to pause at this point? Well, or because in your statement you have been quite absolute in what you will be doing, but are there any indicators that will make you pause and go?
Well, the indicators are household spending, how these various factors affecting household spending are balanced out.
But are you able to indicate by what level you're looking to see them fall?
No, we don't. We don't kind of operate a world where there are critical thresholds for each variables, because there's so many individual pieces of data. We put the pieces of the jigsaw together and look at what the overall picture looks like. And the pieces that we're looking at very carefully are retail spending, consumer spending in the national accounts, the business surveys, the wages data, and the inflation data, which we now get monthly, thankfully, and what's going on in the global economy. So they're the pieces that we put together, and we try and form an overall picture from those pieces of data, and we'll do that again in a few weeks' time. If we need to slow down or to stop, then we will. If we need to keep going, we will.
So one cost of living pressure that's being felt widely around the country is obviously around energy costs. How has the electricity futures markets responded, in your opinion, to the energy price relief plan?
Yeah, the energy future prices have come down a long way.
Yeah,
Sorry, Lucy, you've got... And the energy package that the government put in place, the caps, we're expecting those to reduce inflation by 0.5% in 2024. So that's material. And the rebates that some people will get will have a temporary effect as well, maybe another 0.25% at various points in time. So that's a 0.5% reduction in inflation. That's good news. And Lucy, you've got the
I've got the
prices.
So as at November, so when we put our November forecast together, the futures price, through this year was expected. So for wholesale electricity was expected to be above $200 per megawatt hour, and before coming back to something more like 150. And I mean, there's seasonal variation in that, but that was what the futures curve looked like in November, and that was what went into our inflation forecasts. Now, the peak is more like 140, and it comes down to sort of more like 100 over the subsequent years. So people have responded to the policy package that was announced, and also just to the developments in the market. I mean, the other thing that's happened is that since then, energy prices around the world have come back to roughly where they were at the beginning of the year, pre-invasion. That's true for thermal coal and gas and oil. And so, those energy prices are still higher than they were a few years ago. And so it still is an impetus to inflation, but it's a smaller impetus than we would have known in November.
So you feel that without the plan that the energy costs might have been higher?
Well, that's what our forecast had in November. We had a different profile for inflation because there was going to be a bigger increase in inflation this year. There's still going to be an increase, but it would have been bigger had that not happened.
Sure.
And we also, in our forecast, we actually use an input-output model to actually then model the second-round effects on business costs and thus on prices. So we had an allowance in underlying inflation in 23 and 2024 for the higher energy costs, and so that's also smaller.
And Barry from Les Moody, he wrote into me to speak about the impact the increase in interest rates is having for him. He is on a pension, as a fixed low income. He does still have a residual mortgage, and it just is not sustainable for him to meet those payments with interest rates rising. And his challenge is to understand, and there's been a fair bit of commentary in the media, obviously in the last week or two, about whether, when you meet with governors from around the world, whether you discuss other models for monetary policy, and some of the, and perhaps not monetary, perhaps it will be on the fiscal side, but there's been discussions around perhaps looking at increasing temporarily into superannuation accounts, a suggestion of looking at tax models where there is super profits being made, as was suggested earlier, like with the banks. Like, are there other methods whereby there's a fairer means of being able to essentially draw cash out of the economy temporarily without it having an unfortunate, but seemingly the impact always being on those who can least afford it?
Yep. Thank you. It's a good question. We kind of touched on that before, because the other alternative is to use the various fiscal instruments to take cash or add money to the economy, and the problems there are fiscal policy, well, the issues are fiscal policy has got structural objectives as well, not just cyclical ones. Changes in tax rates and government expenditure are highly politically contested, and getting through Parliament is difficult. And the third is it takes time. We've got an annual budget cycle, and so it takes time to. So you put all those things together, and the way the system works, for better or worse, is that the task of macro management is interest rates, and it's very uneven. You could imagine, and some people do imagine this, an alternative world where fiscal policy is operated in a different way. There are some structural elements that are determined by the government, and there's a cyclical element that is given to a more of an independent body and who can use the instruments. So some people talk about that. No country has gone down that route though, because of the kind of the governance and the political and the timeliness issues. But at least in principle, we should be thinking about it. But it's not for the central bank to do that. It's really for the political process to do that if they wanted to. I've got to do the job I've been assigned to do, and that is to get inflation back down, hopefully keeping the economy on the narrow path, and the tool I have to do is interest rates, and we're going to keep using it. But you could imagine a different world, but we're a long way from it.
And just perhaps a quick one. So we heard from the economist Chris Richardson talking about, as a rule of thumb, that every $6 billion in the economy translates into the need for rate hikes, and conversely reducing that translates to the equivalent of one less rate hike. And I want to understand, because we talk so often about the consequences of the pandemic, and obviously it was a time of uncertainty, and I don't think anyone would question the merits of having to have done such a major, stimulus spending program. But the effect of money and the numbers are difficult to quite quantify. It depends if you include churches and private schools and so on, but ranges from anywhere from $26 billion to double that amount and then some of money that went to companies that didn't experience a turnover decline, and in fact made profits. So what has been the effect of that lack of targeted spending and funding going into the economy on companies that were actually quite profitable through the pandemic? What's been the flow-through consequences on the inflation impacts we're experiencing today and the consequential rate rises you're having to take?
Yeah, we're not able to identify any specific kind of link to those payments to inflation. Those firms obviously had stronger profits than they otherwise would have, and what they did with those profits is going to vary by company. Some would have paid extra dividends, some might have done more investment. So that could have added to aggregate demand, but I don't think that's the main source of, I know it's not the main source of the inflation problem we have, and I can't identify a separate influence from that channel.
Thank you.
Mr. Wyatt. Thank you, Chair. Thank you, Governor, and everyone. Dr. Charlton, in his questions, asked about the impact of higher than expected unemployment figures from yesterday, and you said it didn't alter your thinking about the state of the economy, but you would have to, in another month, you may have a rethink or reconsider. I want you to assume that when you reconsider it, there is a third month of increased unemployment. Would you then consider that rate rises are a contributing factor, and would that adjustment reduce the case for further rate rises?
Well, we're in the world of hypotheticals, and as a central bank governor, that's a tricky world. Lucy was saying before that we're expecting the February employment number to be
Stronger
a decent
than it would otherwise
one,
be,
because,
yeah.
and if we saw kind of another weak one, that would be a pretty big piece in this. We said we've got a jigsaw puzzle that we're trying to get the overall picture. So if we saw further weak employment growth in February, that would be a big piece in that jigsaw puzzle, but it's only one piece. If employment growth was slowing a lot and we saw retail trade and consumer spending data suggesting things are slowing down, and we're hearing that from businesses as well, that would be pretty powerful information. We're not on a predetermined path with interest rates. We meet every month, and we're looking at all the pieces of the jigsaw puzzle every month and trying to put them together, and if those pieces tell a different story, then we'll respond. Inflation comes down more quickly than we expect and the economy slows more quickly, then we don't have to do as much on interest rates. And I've got an open mind, but our assessment at the last meeting is that we need to go up further. But if the information comes in to suggest otherwise, we've got the flexibility to adjust quickly.
Thank you. I want to ask your views on why there is a divergence between the cash rate and the various policy rules. I think you have the RBA has its own rules under the Martin system, but there's also the Taylor rule. Those rules suggest we should have a cash rate much higher than we do now. In fact, we're at rates that seem lower than the historical averages. I want to ask your opinion about why those rules are not helpful, or at least are different, and is that due to temporary factors?
Yep, it's a good question. I know Lucy and your staff have been looking at those, so do you want to start off?
So thanks for the question. Routinely, we look at alternative policy paths as a way of understanding more about our forecast and more about the outlook. A Taylor rule is simply where the interest rate varies according to deviations from inflation target and the unemployment rate relative to the NAIRU. And that was simply on the basis that the weights that John Taylor came up with were simply what the Fed had historically done. And similarly, and we could apply that into our Martin model or any other model. Similarly, you can apply other policy rules into those models and see what pops out. And I think the important point here is, and it's similar to what you got if you just use a standard model for the NAIRU itself, most of those models work on the assumption that everything's driven by demand. But we know that not everything at the moment is driven by demand. Some of it is, but a lot of it's supply. And most of and in some sense, if you're estimating a policy rule based on a period of time when almost all the shocks were demand, you're going to get a different policy response than what you would really want to do when you know that you've got this big global shock, where big global supply shock that is already coming off globally. So it's really about applying more judgment and working out in what sense is now different and in what sense is now not different. And so looking at the whole set of data that we have available, and we talked about, there are other questions where we said, well, do you have more data about this and more data about that? Most of those policy rules, they're good to look at, they're a good rule of thumb, but in the end, they're just a mechanical rule that says output or unemployment and inflation, put them in the formula and here we go. And they're based on a history that had very different shocks to what we're facing now. But sure, we look at them.
Yeah, but they're just, our models are not well suited for supply shocks.
Sure.
We've had big supply shocks, and then it affects the NAIRU and the estimate of kind of the interest rate we should have coming out of these models. So they just can't deal with supply shocks.
Thank you. Before the Senate committee on Wednesday, and you repeated here today, you said that you described the effect of fiscal policy in the short term as neutral. Again, I want to put a hypothetical to you. If the budget deficit was lower, or even the budget was in surplus, which would be nice, what would the effect be on interest rates?
Again, it's hypothetical, but if the budget deficit was getting smaller and smaller every year because there were tightening measures being taken up, aggregate demand in the economy would be less, and that has obvious implications for interest rates. But that there would be other effects from that as well, wouldn't there? The tightening of fiscal policy year after year would mean that some other fiscal objectives might be prejudiced. So,
I'm going to press you on an answer, Governor. What would the effect be on interest rates in that scenario?
It would depend upon the magnitude. Obviously, you had a very sharp tightening of fiscal policy, excuse me, it would affect interest rates. But again, it depends. I don't know what the magnitude of the tightening would have to be to do that. But remember, the budget deficit has swung in a fairly wide margin very large margin, isn't it, in the last few years. So if we're talking a concerted and significant tightening of fiscal policy, then that would have implications for interest rates. How much? I don't know, but the principle is true, is right, isn't it?
But you would agree that, in principle, that if the budget was in surplus or it was in a much better position, that would make your job easier?
I wouldn't go that far because I've got to be careful here. But what I can say is, if there was a very significant tightening of fiscal policy, that would have implications for interest rates. Whether kind of if the budget deficit kind of goes from 2.5 to 1.5 or something, it probably maybe not have that much effect. It would depend upon what other pieces in the jigsaw puzzle were telling us. But if fiscal policy was tightened a lot, that would have other consequences, but it would have implications for monetary policy. It's true.
In your opening note, you said that since the pandemic, household savings have increased, although you also further note that that's not evenly distributed.
Yep.
And in reply to Ms Spender, you said that Australia had the largest stock of household savings in the world. We all know no economy was immune from the pandemic. Can you explain why we are such an outlier?
We don't have the highest kind of absolute level of savings, but what we do have is the biggest pool of excess savings following the pandemic. We saved, the current pool of savings is equivalent to 20% of household disposable income. Maybe one or two other countries are around there, but a lot are kind of in single digits. So we saved a lot. It was partly because the labour market programs kept people in jobs. That's positive. So people kept their jobs and they kept getting income. And we weren't able to travel and do the things that we normally do. So the fact that people kept their jobs during the pandemic and they couldn't spend as normal, they saved. And the amount of saving that we collectively did relative to our incomes is as big as anywhere in the world. And now we've got those savings to either spend or just as part of our accumulated wealth. And that's one of the uncertainties we're dealing with. How do people view the extra saving they did? Is it a piggy bank that you can go and spend next month? Or is it just part of your family household wealth that just sits there and maybe you'll spend very gradually, if not over time?
Thank you, Governor. Do you think that the way our markets allocate and arrange capital needs renewing and restructuring? And if so, how?
I strongly believe in the benefits of a market-based economy that's delivered strong benefits in rising real incomes for us and many other countries around the world over long periods of time. So that's the principle. Market-based economies work, but they do need to operate within the context of a regulatory environment, and government has a role to play in that. So I probably can't say much more than that. Capitalism works. It's made, sometimes we can forget this. We complain a lot in this country, and understandably, but we enjoy a quality of life and a standard of living that very few other people in the world enjoy. One of the world's most wealthiest, prosperous, equal countries. Australia's a fantastic place to live. I think amongst all the complaints, we can sometimes forget about that. And we've built this fantastic place because of hard work of Australians and private markets operating within a system that's the guardrails are set by government. You shouldn't forget, it's fantastic. And it's not perfect. And government can kind of help with the imperfections in markets, and sure, there are plenty of imperfections in markets, but I wouldn't be going to a different system. Keep improving the one we've got.
Thank you, Governor. I'll just pop one last question. We all have challenges to consider, and you certainly do, and we do in this place. But sadly, things may always get worse. What would worry you most for the economy, whether it's further conflict, a financial crisis, a pandemic, or something else? But in short, what keeps you awake at night?
Nothing keeps me awake at night. I'd like to be in the media less, but apart from that, nothing keeps me awake at night. I do worry about a retreat from globalisation and free trade, because I talked before about Australia's become a wealthy, prosperous country. Partly that's because we've traded with the rest of the world. And so if we backtrack from that, then in a given year it's not that big a deal, but over time it's corrosive. So that would worry me a lot, and the possibility of further geopolitical events impairing on our prosperity. They're the two things that would...
And just as a follow-up, are there people within the bank who engage in contingency planning for some of those worst-case scenarios, so we're not caught off guard?
Well, if those things happen, we will be caught off guard, I think, but there's limited as we can do in advance. I mean, most of the, we're setting the interest rate and talking. They're our two instruments, and our focus is the next 2 years. So it's hard for us to plan what we would do with interest rates if there was some major geopolitical event. In the event that something like that would happen, we look at the piece of the jigsaw, see what the picture looks like and respond. So it's pretty hard for us to do much forward planning with the tools that we have.
I think that was demonstrated by Ukraine.
Yes.
We didn't have a plan for what happened when Russia invaded Ukraine. We saw what happened, and then, well, the picture looks like this. What do we do? We'd obviously done some high-level thinking about the general issues, but we haven't got plans for lots of different contingency events.
Well, in fact, a really good illustration of this is prior to the global financial crisis, the Financial Stability Department did do a lot of analysis about pandemics and how the financial system might work, and what might happen if lots of people were sick and lots of people had passed away. Well, guess what? The one thing we didn't think about was what would be the economic effect of a lockdown, because of course that wasn't any government's pandemic management plan. So you can plan. Plans are essential. Planning is essential, but plans are useless, Eisenhower said. I think that really shows you. We'd thought about the possibility of a pandemic, but everyone had an avian flu in mind. It was before Zoom, and no one had heard of lockdowns.
I think we always say in the Army, the plan never survives the first shot.
That's right.
Yes.
Yes, I'm a Navy wife, I get that one.
Gotcha. Well, thank you very much, and thank you, Chair.
Thank you. So I'll hand over to Mr Ray for 15, and then we'll have a final couple of minutes from the Deputy Chair. Mr Ray.
Thank you, Chair. Good afternoon, Governor. I'm sorry I can't be there with you today. I'm calling in from Melton, in the outer western suburbs of Melbourne. Given your keenness to avoid the bubble, consider yourself to have a standing invitation to come out here and discuss the impact of interest rate rises on our community any time.
Thank you.
Bit further than Barrenjoey, but it might be a more insightful conversation for you. Can I begin just by further exploring that dynamic between supply side and demand side factors on the overall inflation impact at the moment? You've indicated in that recent statement that perhaps half to three-quarters of domestic inflation is driven by supply-side factors, namely international pressures. Can you just talk us through the analytical process for determining that figure relatively?
Well, Lucy, that was...
Yes, that was
some of your staff.
Yeah, so a number of the team in Economic Research Department and Economic Analysis Department did that work. So in the box, in the S&P, we had two different models, and you will get different answers with different models, and the answers are a bit different. So one of them is just you look at all the different bits of the CPI and say, well, if the price went up and volumes went up, that was probably demand. If price went up and volumes went down, it was probably supply. So that's really, it's almost an accounting decomposition. So that was the first graph. The second graph showed a somewhat more sophisticated decomposition using a different model called a dynamic stochastic general equilibrium model. Try and say that 5 times fast. And so that was just a different decomposition using different assumptions about what's demand and what's supply, and with a bit more framing around what constituted a demand shock versus a supply shock.
And given that, what level of confidence do you have in that calculation?
Well, I think the fact that we used two different models and we got answers that were qualitatively similar says, I'm very confident in the idea that at least a quarter of the inflation that we've seen, and probably, up to a third, that range being due to demand, I think is reasonably sound. And that's why you use more than one model to get your answer, so you can triangulate and test how robust your results are to different assumptions.
Other central banks have done similar exercises and come up with broadly similar numbers as well.
Okay, thank you. I'm going to assume that you're not suggesting that cash rate adjustments play any significant deflationary role in addressing those supply side constraints. Given that, is it actually possible that rising interest rates may be suppressing domestic appetite for investment in supply chain innovation and robustness? You've sort of put to us that, that it is the responsibility of others, namely government, to enhance supply to the extent that is possible. Is it theoretically possible that those interest rate rises may be suppressing that appetite for domestic investment in doing so?
Well, what we're hearing from business is that the cost of funding isn't a major issue. When we talk to them, it's all about labour supply and getting the workers with the right skills. That's the main constraint on them investing. Very few people say, well, look, I'd like to invest more, but the interest rate's too high. They worry about the uncertainty for aggregate demand, but the cost of finance with an interest rate of 3.35% should not be an inhibitor to investment.
So with confidence rates falling across, most sectors, you don't think that, at least common understanding would have us believe that is largely tied to interest rate rises to address inflationary pressures. The possibility of, further economic decline in the coming months and years, you don't believe that would have any role, that would play any role in suppressing that appetite for domestic investment?
I think the uncertainty about the outlook does weigh on some firms' investment plans. That's unambiguously true. But I also know that firms are telling us that they're operating at an extraordinarily high level of capacity. They need to expand to invest that capacity, and the main inhibitor to that is the supply of workers. That's the main story. Uncertainty about future demand might lead some firms to slow up a bit, but with many operating at capacity and telling us in the business surveys that current conditions are quite a long way above average. And even business confidence now in some of the surveys has returned to average. So we're in this strange world where consumers feel very negative. It's the higher interest rates and the higher rents. Consumers feel very negative, but businesses tell us that people keep spending, operating at a higher level of capacity, and they want to invest. But you're right, if businesses are uncertain about the future, that's going to slow their investment plans eventually.
Well, and the committee has seen data that supports that current expenditure is, as you say, is relatively strong, but that confidence is remarkably low. Business confidence is remarkably low, respectively. Wouldn't it just be common kind of, wouldn't you draw the conclusion that if your confidence about the future is so low that you would be, even if labour were available, that you may be loath to invest in whatever those supply chain requirements were in order to take advantage of excess demand?
Well, in principle, you're right. If confidence is low, you don't invest. But the various surveys that we've seen just recently suggest business confidence isn't extraordinarily low. It's kind of roughly average. It's consumer confidence, which is very, very weak. Excuse me.
So notwithstanding that, but you agree though that it's possible that rising interest rates may be perversely exacerbating, or may in time perversely exacerbate supply side inflation by hindering the efforts to enhance domestic supply chain sovereignty.
Well, it may slow investment for a while. That's true. That's partly how monetary policy works. When we raise interest rates, the economy slows down, and firms will invest less if the economy is slowing down. So that's the process of getting supply and demand into balance.
So you're right in principle. Some of the distributional considerations. I know we've touched on them already, particularly around the distributional impact of interest rate rises across the various communities. I think one of the assistant governors was speaking about a sort of a pentile model earlier, and perhaps it's best to stick with that, although I'm in your hands. I'm keen for you to talk us through some of the socioeconomic segment or cohort dynamics on that pentile basis, if need be, in relation to demand side inflation. I guess what I'm really getting at here is I want to know, of those pentiles across those socioeconomic groups, who is causing the demand side inflation in the economy right now?
I don't want to single out a particular group, but we've got kind of two groups more than two groups, but two main groups in the population at the moment. People who don't have a large mortgage or no mortgage at all, who've done a lot of savings over recent times, who are getting, have got good job prospects, their wages are rising quite quickly and are feeling pretty prosperous, and they're spending. There's a large number of Australians who are in that fortunate position. There's another group of Australians who have borrowed recently, who have a high level of debt, relatively low income, and feeling firsthand the effects of higher mortgage rates, and a related group who are paying a lot more on their rents. So we've got two groups of people at the moment at a very high level, and their spending is quite different. And this is the unevenness of monetary policy that I've spoken about a few times. And it's kind of very difficult for the people who are struggling. I know, seeing other people who can spend based on the fact they've got jobs and lots of savings and a small or no mortgage. There's only a third of the population have a mortgage. Roughly another third own their house outright.
Yeah, slightly less than a third.
So it's a very disparate story across the population, and we're trying to work out how it all fits together in this, putting together this picture we talked about before.
So I don't want to put words in your mouth, Governor, but in common parlance there, could one assume that essentially what you're getting at is that there is a pentile or a cohort in the upper group of income earners who are spending within the economy and perhaps driving the demand, that there is a demand side inflation perhaps driving that. And at the other end of the spectrum, there's that lower income pentile or lower income group who are perhaps more adversely affected by rising interest rates disproportionately, and yet aren't playing a role in driving demand side inflation at all.
No, well, demand is demand wherever it comes from. So I don't want to say you're to blame and you're not, but there
some people have money to drive demand and some people don't.
Yeah. There is strong demand coming from parts of the population, with people with jobs, savings, and who aren't really being directly affected by higher mortgage rates.
So we would generally refer to them as wealthy people.
Well, they're not. No, I wouldn't say they're all. Well, there are people across the whole income distribution, but more likely to be wealthy than in lower income. You're obviously right. So it's very disparate and it's uneven.
Okay.
And it's tough.
What analysis does the bank conduct in relation to real-time demand behaviour adjustment in relation to cash rate adjustments? So as the cash rate rises, who across that distribution, that spectrum, those various 5 pentiles, who changes their consumption behaviour, most acutely in proportion to cash rate adjustments?
I don't think we have that kind of level of disaggregation, but what we do is talk to the retailers and to the banks. So sometimes the retailers tell us that one customer segment is responding quite quickly and another customer segment isn't. So how many retailers do we talk to every month? Like
all the big ones every month. Obviously I can't, for commercial and confidence reasons, I can't say who we talk to, but we, talk to all of people, all the people you're thinking of in the retail sector every month, and they have a really good handle on things. And also because some retailers concentrate on different segments of the population, so not only can they say something about the dispersion within their own customer base, but you can also learn something from what retailers who target sort of the upper end of the income distribution versus lower income people. One thing I just want to pick up on there, of course, is it's not only housing costs that are impinging on people, and you can see this in the consumer sentiment numbers. mortgagors have the lowest consumer sentiment, but all three housing tenure groups, renters and outright owners, also have low consumer sentiment. And that's telling you that inflation is really hurting people as well, because even the people who are not affected by housing costs, who are disproportionately on indexed incomes because of the role of the indexation in the pension system, even those groups are really feeling the pinch of higher cost of living, and that's why inflation is such a negative for so many people.
Yeah, I think, can I just reinforce that point? I think it's a really important one, because much of the discussion is about interest rates, understandably, but inflation is hurting everybody.
Yeah, no, we all agree with that.
Yeah.
Just coming back to this though, the key tool that you guys have are cash rate adjustments and effectively interest rate adjustments for people with mortgages, but you don't have the ability to disaggregate across the population who actually changes their behaviour. The whole point of the interest rate adjustment is to drive down demand, but you can't tell us who actually responds to that intervention.
We don't have that level of disaggregation. We talk to the retailers and also talk to the banks. The banks have pretty good information systems these days, and they can tell us at a higher level which type of people are responding to the higher interest rates. But
given that you don't have that data, can we would it be fair to assume, and I'm leaning on your judgment here, but is it fair to assume that those people who have less headroom in their household budgets are going to be more sensitive to interest rate changes than those people who are perhaps at that wealthier end of the distributional spectrum that we talked about, and therefore they're going to be more sensitive to changing their demand behaviour? And conversely, or rather inversely, those people who are wealthier, who we've sort of hinted at perhaps being the ones that are actually driving this demand behaviour, are less affected by interest rate changes overall.
Well, the people with mortgages, they're the ones who feel the effect most directly, and got people with mortgages across the whole income distribution.
I understand that. What I'm saying is, is the group that are in that upper pentile, that are of the higher income end of the spectrum, mortgage holders as they are they less affected in terms of adjusting their consumption behaviour by interest rate rises than others across the economy?
In most cases, that would be true. I mean, some of these people also own their house outright, and the house prices are falling, so that could be affecting their wealth. But it's true, if you've got lower income and a smaller buffer and a mortgage, the tighter interest rates are affecting you more than someone who's in a completely different position.
If I can help out there, what we have tracked is how mortgage prepayments, the buffers, the excess buffers, if you like, have evolved across different income cohorts. What we've observed in the last 6 to 9 months is the biggest decrease in excess buffers, if you like, has actually come from higher income households, and that's principally because higher income households in Australia own most of the housing debt.
Thank you. That said, you said earlier in the piece...
Final question, please.
Yeah, sure. Yeah, you said earlier in the piece that there's strong demand in domestic hospitality and travel. These things seem to be sectors that are probably, the places where the wealthier people are earning money. So just to summarise, effectively what you're telling us is that the wealthier cohorts are more likely to be driving inflation because they've got the headroom to do so, and they are spending money in those sectors where we're seeing upward pressure on prices. And yet they are also the group that are least likely to adjust their behaviour, their expenditure behaviour, as interest rates go up.
I wouldn't characterise it like that, because I just don't know enough about where the demand is coming from. It. What we know is right across the country, demand has been strong. And when demand is strong, firms don't discount and they put their prices up. But I do agree with the point that there's a lot of unevenness, and people with mortgages, particularly low-income people with mortgages, are feeling a disproportionate, bearing a disproportionate share of the burden here.
And that's quite the point that I'm getting at, Governor. I'm asking a bit there, but the point that I'm getting at is that the tool is perhaps not the appropriate tool, given I support the effort to try and reduce domestic demand-side inflationary pressure. but the tool, in fact, is hitting the wrong people.
Well, it's the only tool we have, so we have to use it. And to return very briefly to the point I made right at the beginning, if we're not successful here and we have higher inflation persist, we'll have even higher interest rates and more unemployment, and those things will hurt disproportionately the people you're talking about now. So we've got to think about both the short term and the medium term.
Thanks, Mr. Ray. And one last question from the Deputy Chair.
Very quick, and you touched upon it previously in answer to Ms Lawrence, but the market would appear to be pricing cuts to the cash rate early next year. Under what scenario would you see that as plausible? And would a rate path on the way down be similar and consistent? You talked about consistency being an important part of that.
I mean, many other countries, markets are pricing in central banks will cut rates roughly the middle of next year, or sorry, the middle of this year. Yeah, the middle of this year. So they peak mid-year and then they start to come down. In Australia, the market pricing at the moment is kind of rates get up a bit and then they just stay there this year and start coming down next year. That's current market pricing. But that can happen if we get on top of inflation. If inflation expectations stay well anchored, the supply side problems get fixed up, wage growth and wage setting doesn't kind of move up too fast, and we can come back on that narrow path that I talked about before. So that is a plausible scenario, that rates rise and then start coming down next year. But a few things are going to have to go right for that to happen. It's possible, but there are other scenarios as well.
Thank you, and may you live in interesting times.
Thank you. Thank you for appearing before the committee today. The committee secretariat will be in contact with you in relation to any matters arising out of today's hearing. You will be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to transcription errors. I would like to thank all of the witnesses and members for their time today. I declare this public hearing closed.